Okay, apologies. We just need a minute to get ourselves in order, so we'll get started in just a minute here.
Thank you. That's very kind of you.
Yeah, I don't know what I did with mine. It must be in my bag or something. Okay, my apologies for the delay. Good morning to everyone. We'll go back on the record for our third day of hearings in docket number 220701. So we are going to begin this morning with administrative matters. I think we may have one or two read-ins, and then we'll resume cross with authority staff. So Attorney Pace, do your clients have the two read-ins this morning?
Yes, good morning, Chairman. They do have the two read-ins.
Very good.
Starting first with read-in C, that was an update to RRU 246 that asks about the property tax appeals in Easton and Fairfield. Ms. Szabo, can you proceed to provide the read-in?
Certainly. So the question had been whether the property tax expense that we have in the case, whether that reflected the current assessments, and the answer is yes. The company is obligated to pay the property taxes at the stated assessment while any appeals are pending. So that is in there. And also at this point, I just wanted to highlight that in addition to those assessments, the company has been seeing significant increases in other properties that we own as well, where we'd be looking to potentially dispute those assessments. The follow-up question on that read-in, Mr. Bacalina had asked what the rate making mechanism or treatment would be of those costs. So as it stands right now, without the existence of a property tax mechanism adjustment, if the company is successful in those appeals, there will be no rate making adjustment provided for that. The only way to account for those would be to incorporate the property tax adjustment mechanism the company proposed.
Okay, the next was read-in D, and that was an update to QRRU 89, in which the company was asked to provide their net write-offs for year-to-date 2022. Can you provide that, Ms. Szabo?
Yes, so net write-offs through October of 2022 amount to $326,091, which for context, that's almost 2 times what we currently have in our revenue requirement, which was provided based on our 5-year historical write-offs. Again, the write-offs are artificially low due to the COVID-19 pandemic. And another point of reference, the 326,000 only represents write-offs for single-family residential customer class. It does not reflect any write-offs on the multifamilies, as we have not commenced those yet in 2022. So again, this really supports the need to have the bad debt mechanism that was implemented in the COVID-19 docket extended to this rate proceeding.
Thank you. That completes the read-ins unless the chair or others have any questions for us on those. Thank you, Chairman.
I appreciate that. Actually, Ms. Dabo, can I ask a follow-up question on that? So the bad debt that the company is proposing, I'm not sure if allowance is the right word you would use here. It's 160,000, is that correct?
It's a 166,000 representing a 5-year average of our historical net write-offs.
Okay, so that's what the mechanism that the company is proposing is to put that into your revenue requirement and then to have the differential between that and your actuals reconciled at your next rate case?
That's correct.
Okay, so yesterday there were some questions from the authority staff about an alternative mechanism to doing that, to reconciling it through perhaps the RAM. Do you recall that?
My recollection of yesterday's discussion on that topic was in reference to the property tax adjustment mechanism, not the bad debt mechanism.
Oh, okay. Can I ask you that question with respect to the bad debt? So I think there's some parallels on the electric side that you may or may not be aware of, but there's a differentiation in the electric and gas, of course, with the financial hardship, which water does not currently differentiate for financial hardship customers, correct?
That's correct.
Okay. I need to put a pin in that because I want to come back to that question. But if the company was going to, would the company have an opinion about a rate making treatment where the differential between the bad debt allowance that you've built into revenue requirements was instead reconciled through the annual RAM, which I understand is currently used for a more limited purpose?
So just to make sure I understand, it would be an additional reconciling valuation on there. So we would separately calculate our RAM for authorized revenue, what was collected, and then separately assess net write-offs versus authorized write-offs.
Yes.
I don't foresee any issue with that.
Okay. And if it were, so the 166,000 amount, and I know we have a late file exhibit forthcoming that I asked for about, that would give some more granularity, but I'm still unclear about how we arrived at the 166 value based on the response you gave in your read-in this morning in terms of it being perhaps an artificially low amount based on the COVID response. So can you just walk me through perhaps one more time how we arrived at the $166,000 recommendation?
Yes, so we followed past practice, which in our prior case, we had presented a 5-year average write-off. And the period that we're presenting due to halting any write-offs during the COVID pandemic resulted in very low write-offs. For example, in the year 2020, we only had a net $37,000 of write-offs. So incorporating the COVID years into that 5-year average resulted in what we're calling an artificially low number because of that. In addition, it's yet to be determined what impact the COVID pandemic has on future write-offs. We know that our age receivables are significantly higher than we've historically seen. So the company doesn't have a good indication right now of what our future write-off levels could potentially be when we begin to open up our collection practices and pursue the outstanding receivables.
Okay, and did the company run any numbers where you would have excluded the 2 pandemic years or do an alternative 5-year average like predating the COVID years?
I don't have that at my fingertips, but there's data available. We could certainly provide such a calculation. I just don't have that currently available.
Okay, I apologize for answering a read-in with a read-in, but perhaps after some break later today, if you could give me the 5-year average, like ending perhaps in 2019, just so we can cut out
Certainly.
a portion of that pandemic.
Okay.
Thank you. Okay. Thank you for the indulgence. I think maybe we can resume with cross-examination at this time. I'm sorry, I see Attorney Marshall. Please, very good. If Attorney Marshall can please approach.
Thank you. With the chair's permission, Deep would like to request that Mr. Daniel Lawrence be added to the operational efficiencies and cost savings non-revenue water and conservation panel. We've already discussed with Aquarion's council, and they are amenable to this ask, and they've made Mr. Lawrence available for today. So I just wanted to bring that before you.
Thank you, Attorney Marshall. There's no objection from the company.
No objection. The witness is here today and we can produce him. Thank you.
Very good. Thank you. We'll do so. Okay, any other administrative matters before we resume cross? All right, seeing none, we will pick up cross where we left off yesterday with the IT employee compensation, staffing levels, and succession planning panel. And we are up to Ms. Skouras on behalf of authority staff, please. Just need the microphone there, please.
Good morning, company. Rita Skouras from Authority staff. I will direct my questions regarding defined benefit pension plan, the post-retirement benefit plan, and SERP. So I see the correct people there in front of me, which is thank you for the panel. Regarding pension expense, I took a look through the filed interrogatories and note that a copy of the ASC 71530, previously known as FAS 87 pension expense explanation, has not been filed in the application or in the interrogatory responses. So I would like to have a late file where the company can provide that for the record. So commissioners, that would be late file
24.
24, and we would call it defined benefit pension FAS 87 copy.
You'd like a copy of those documents?
Yes, please. Yeah. And if there's any update since, the known updates to that document would be helpful. So with that, we'll move into the cross-examination. If you would refer to response to RRU 6, RRU 7, at OCC 22 attachment A, and specifically lines 1 and 2. Okay, staff has brought up the item here for you. So if you look at the exhibit on the screen there, OCC 22 attachment A, I have highlighted 2 items. One is the pension expense service cost of about 2.78 million, while there's pension expense, which is negative, of 899,369. Is there a problem? First, can you clarify how these items are different and why these are kept track or are kept track of separately?
I'm certainly not an accountant, but I believe there was a gap accounting regulation that requires companies that provide this benefit to separate the costs related to active service and then any other costs in a separate line item for disclosure purposes on financial statements.
Okay, thank you. Subject to check, if I net those two items, the amount is 1.886932. So $1,886,932. Just hold that for a minute. Now, if you would cross-reference to the company's proposed pension expense of 1.865741, which is provided in line 4 of Schedule C-19. If you could clarify for me why there's a difference between what's in the what is proposed for the pension expense and the net of those two numbers, because my understanding was that if you net those two numbers, that should be your pension expense. Maybe there's some adjustments I'm not aware of.
I just want to be sure we're looking at the same value. So on C.319.2, I have pension expense service cost of 2,765,110. And that compares to the OCC schedule of the 2021 column, 2,765,110.
Okay. There's a number, the 1.865741, which is Schedule C 3.19, and also in OCC 62 and 189. Can you explain what that is?
Oh, I'm sorry. Yeah, that is the sum of those two values. I'm looking at an Excel file, so I had actually I had the detail in here. So it's 2,765,110 less 899,369, providing a total of 1,865,741.
Okay, and that is the proposed pension expense.
Correct.
Okay. So the two numbers that I netted together, they're not related?
Those are the same number. So you're adding together rows 1 and 2
Yes.
on OCC 22 attachment 1 in column 2021.
Yeah.
It
Okay.
totals 1,865,741, which agrees with Schedule 3.19 for pension expense.
Okay, all right, thank you. We'll move on from that. Okay, if you go to RRU 7, the response regarding actuarial minimum contribution, there has not been a required minimum since 12/31 of 2020. Is that correct?
That's correct.
And can you explain why there's no actuarial minimum contribution at this point?
I believe it's due to the fact that the funding levels of the plan are adequate to provide the payments of the pension. So it's not actuarially required to be made.
And I believe reading, and I don't have the actual site, the plan is not fully funded, is that correct?
That's correct.
But it's, from what you're saying, it's funded enough that there's no longer a need for a minimum contribution?
Well, it's not needed at,
Yeah, sorry about that.
that's okay. It's not needed at the particular time that the pension is valued. It doesn't mean that there won't be a requirement in the future.
Okay, well, that could happen subject to check if there are losses to the plan, is that correct? Or, because at this point, you're not funding any more employees, it's a closed plan, is that
It's a
correct?
partially closed, so the plan continues to provide benefits for participants who are eligible, but the plan is closed to new entrants
Right, new entrants.
in the past.
But you do have planned, or, just to be clear, the current members of the plan, they're still accruing a benefit?
Yes.
Okay. So if you now turn to response to OCC 61 and OCC 62. Regarding the proposed pension expense, the 1.866 million approximately, in comparison to the OCC 61 contribution of 4.761 million. Regarding the contribution portion, it appears that beginning in 2018, the cash contribution exceeds the pension expense. Is that correct?
That's the expense on the screen, right?
Okay.
That's correct based on what's presented in OCC 61 and 62.
So you have contribution greater than what the expense is that right?
Yes.
Okay. Can the company explain why it's contributing more than the actuarial computation essentially requires?
The company is working to try to fund the plan 100% to mitigate any risk in the fluctuations over year. As you've seen, there's due to discount rate and market performance, those numbers fluctuate. So to the extent possible, we will fund the plan as much as we can to try to get it to 100% funding at some point.
Okay, there's a difference between requirement, which is what the actuary computes as the actuarial minimum.
Mhm.
And at this point, there is no minimum, correct?
There's no required
Or
minimum.
That's per the the pension it's PBGC, the Pension Guarantee Board. They have their rule, and you need to meet that in order to maintain the plan at in compliance. Is that correct?
Yes.
Okay, so there's that bit to it, and then there's the elected portion, which is the contribution that the company elects to make.
Correct.
Has the actuary indicated to the company that you should be contributing more than the minimum contribution, or what has driven the company to contribute more than is essentially required?
The actuary provides the company with information to manage the plan to be in compliance. And then the company will look at the plan and try to make the best decisions to ensure that the plan complies with the provisions and can continue to provide those benefits over a long period of time. And in order to avoid any significant declines in the market at some point in the future, to the extent possible, we are trying to fund the plan as much as we can, again, to get to that funding, 100% funding, which at that time we would have different options available to us to mitigate and reduce this expense over time.
Okay, two follow-up questions on that. First follow-up is who within the company has made that decision to contribute as much as possible, as you say, to fund the plan? And second part, how long will it take to get to the 100% funding? Like, where are you now? Because you're ready, you're not fully funded, but you're pretty close from what you testified to earlier. So are you 80% funded or something?
I can read that in affirmatively. I believe we are at about 94% funded.
Okay.
And as you know, things like the discount rate can significantly impact the funding levels from year to year. So while we're at 94 right now, to the extent that the discount rate declines significantly, you can drop, from 94 to, in the 80s, pretty quickly. As well as things like asset performance, which, I think everybody's struggling with right now. So there's a number of assumptions in the plan that drive the overall health of the plan that the company has little control over, other than to try to get that funding to a point where we can eliminate the dependence on these assumptions like the discount rate and interest and the return on assets.
Well, isn't it correct that even if you were fully funded, these actuarial assumptions do impact the fully funded nature? If, for example, the discount rate were to rise, then the value of the plan would come down. Isn't that correct?
Yes, and what I meant was that if you have a fully funded plan, you can choose different ways to manage those pension obligations, whether it's moving your plan to fixed income where those assets are locked in, or purchasing annuities. Not saying we're going to do that, but again, it gives us options to try to mitigate the significant volatility of the plan.
Okay, at that point, is that something that's required or only allowed by PBGC rules when it's fully funded? You couldn't do that now at almost 94% funded?
Again, I don't know. I'm not an expert at it. I believe you can, but it's usually at a pretty significant cost.
I see. And the other question that I had earlier was who within the company makes that determination that we're going to, as you indicated, fund as much as we can afford?
That is made up of people at Aquarion, such as part of the investment committee that makes that determination.
Is there a specific one with the pensions and a specific event? Can you describe that and indicate how often they meet, or do they meet with the actuary?
Yes, we meet with the actuary and with the investment managers on a quarterly basis to review the plan.
And the investment managers, do they also have they supported, for example, the company's decision to fund as much as they can afford, for example, as you indicated?
Yeah, they don't make that determination for us. That is solely made on behalf of the company, but they will, provide us with information to support our decisions or not. They'll give us information for us to make good decision in the management of the plan.
Okay, thank you. Let's move on to pension expense and contribution. If you reference now RRU 9, RRU 10, and OCC 189 Part D, Attachment 3. And specifically, the question is for 189, the Attachment D. If you guys could bring up 189 Word part? Yes. Um, And then the Okay, in here, I've highlighted the portion I'm interested in. Based upon the response, the company indicated that the actuary has revised the 2023 rate year expense, pension expense to 1.225 approximate $1 million. And in the response there, the highlighted portion, I have a question. It says, I'll read it in the record. Since the market losses and volatility commenced in June 2022 had not been factored into the report, the company determined that the report did not provide a reasonable representation of the estimated 2022 expense. Can you explain what that means and why the company still proposes the initial amount in the rate case, despite the fact that your expert has provided a downward adjustment to 1.225 million? And subject to check, that's about a $600,000 downward adjustment.
So the company had determined that although this was an update from our expert, we felt that the timeliness of when we received the update and when we were providing these responses, that there had been enough volatility in the market that we felt that it still was not reflective of the most current information. And so we left the assumption unchanged.
So the 1.8 million and such. Have since this update from the actuary, have they provided a further update to indicate a different expense?
We haven't received any subsequent updates.
Okay, so as far as we know that the current the current pension expense is now the 1.225 approximate million. Is that correct?
As of the last report we received.
Do we have any estimate for the 2024, or is it too soon for that? 2024, sorry.
We typically receive an update from our actuaries in the late December, or early January timeframe to update the 2020, the year's results. But perhaps we can ask them to update something for us, and we can file it in as part of the late file 1 schedule.
In terms of what, for the following year or for the current?
The current year.
Okay. Could we have that as a separate late file?
So that would be late file exhibit 25. And please summarize the prompt.
Okay, we'll say update to OCC 189, most current pension estimate.
And just as a matter of clarification, are the late files issued today due on the 5th or the 12th? Or neither, the 7th?
They are due on the 7th. Late files issued today, tomorrow, and Thursday are due on December 7th. Late files issued next Monday, Tuesday, Wednesday are due on the 12th.
And then, and one additional clarification as well. In terms of our response to OCC 189, I think the important piece that we were trying to do is we're trying to normalize pension expense based upon what we believed was kind of a normalized pension expense. The markets have been tremendously volatile, particularly, subsequent to, the July, August timeframe, where, the S&P 500 dropped, almost 20%, based upon, my eyeballing it right here, based upon what my phone is telling me. So again, I think what we're trying to do is ensure that we're capturing an appropriate level of pension expense that we can expect as part of our cost of service.
Earlier in my question, I had asked, and maybe this is your response, was why the company decided not to reduce it. And your position is the market volatility. You feel that the older figure is more accurate, the 1.886 is more reasonable?
I think the latter, which is that it was somewhat arbitrary in terms of, in our response to 189, we were providing the correspondence that we had received from the actuary, we were giving the information that had been shared with us. But again, because it was a snapshot in time, we don't believe it provided a more holistic view of what the ongoing expense of providing that benefit would be. So as a result, we kind of defaulted back to that number. And I agree with the request for the late file, I think is right on target. I think that's appropriate. Let's update that figure, get that on the record as to what the best estimate is as of this time.
So that would be as close as to the December date as possible.
Yeah.
I'm curious with your terminology of the use arbitrary. Why do you find that to be arbitrary? Because the actuary did run their models for whatever reason.
Well, maybe arbitrary isn't quite the right choice. It was the last time that it was a point in time.
And typically.
And it could have been any other point in time.
Okay, and the company typically doesn't do that, have point in time estimates? You just wait till the end of the year to get your
We budget based on, what was known and measurable when we put our budgets together. And then once we go through the actuarial valuation process, which is done Q1, Q2 of each year, the actuary will update the expense for the company to record on its books. And they will take into account, market volatility and things of that nature to update the expense for the year.
Okay, so that's quarterly updated or just annually?
I think it's done at the end of the year for the coming year. And
December
then,
31st.
and then it's updated once the valuation is done.
I'm a little confused. Wouldn't the December 31st be the valuation date?
It's January 1 of each year is the valuation date. They give us estimates, and then what we do is we have to reconcile, sort of the participants in the plan, because the number of participants, the age, people moving in and out, that's a factor. Those are factors that are used to update the plan expense. So there's a part that's done, prospectively, and then a piece of it that is done retroactively to get the total picture of the plan.
Okay, well, the 1/1 portion is called the annual valuation,
Yes.
correct? And then what is the December 31st analysis that's done the day before? What is that?
I believe it's a true up of the activity that occurred during that year.
So there's not going to be much difference though between December 31st and January 1st.
Well, that would be like another year. So when the actuary gives us the results of the year, they'll look at things like what's the market, the change in the assets and the returns, updated valuation that occurred 1/1 of 2022. Those are the things that they'll use to update, the expense for the year.
Right, okay, but it's only a day difference, is that correct? Or is it a year and a day?
It's a year, so the valuation update that we get, say 12/31/22, reflects the changes in the population from the year before. And then they'll look at what are the asset returns for the year during this year.
As of December
As of-
31st.
Yes, or as
right?
close to it as possible.
Yeah,
Yes.
all right, thank you. Let's move on to reference RRU 14. And I just have a clarification question here. Is it correct that the Aquarian Connecticut defined benefit plan is incorporated into the the Aquarian parent legacy pension plan?
We have one plan that is Aquarion Company, and then Aquarion Water Company of Connecticut is a participating employer in that plan.
So they're valued together, or are they valued separately by the actuary?
They are valued at part of one plan. We report one tax filing, for example, for the whole plan, but the plan is valued at the company level so that we can record the appropriate expense and liabilities on each of the participating employers' financial statements.
Okay. So what you're saying is that when we discussed that the plan was partially, almost 100% fully funded, it's the Aquarian Connecticut part that is almost 100% fully funded. Is that correct?
When I refer to the 94%,
4%,
that was for the entire plan,
Okay.
but the numbers that are reflected in response to these interrogatories are specific to Aquarian Water Company of Connecticut.
Okay, that I understand. So there is like a tiered pension plan. Is there any way for us to determine if the Aquarian Connecticut portion only is 100% fully funded, or somehow different from the 94%? That's the full plan funding status.
I'm not certain that we can provide that. I can certainly ask our actuary, but from an overall funding of the plan, we've always reported it at a consolidated level, and probably 90% of the plan is attributable or so to Aquarian Water Company of Connecticut. We've always found that to be representative of the entire plan.
So the only other portion would be the parent company employees that are still in the plan, like the holding, whatever was the.
Yeah, there are no active participants at the Aquarion Company level, but there are participants in Aquarian Water Company of Massachusetts
Okay.
and New Hampshire as well as part of this plan.
Okay, and how do they, I mean, you said that the majority of the plan itself, the whole plan is Connecticut related. Do you have that breakout between the Connecticut and the other two companies?
Yes, if you look through some of the reports, the valuation reports, it breaks out participants through each of the companies. So it really goes down to the granular level where you can see how many active, how many term vested, how many are in active status by company. And so the actuary is able to break out the costs attributable to each company based on the actual population.
Okay, well, then it sounds like you can answer my question to determine if the Connecticut portion is already fully funded. I would like to maybe investigate a little bit further with the actuary there. And I do have a request here on the table that you've presented in RRU 14. Regarding this table, is it possible to give us the update through 2022 and or an estimate for 2023 if available?
We can update that table based on our best estimate at this time.
Okay, so I would like the late file here, which would be to update the RRU 14 through the 2022, 23, if possible. And to also add a Part B to that, which would be to investigate the fully funded nature of the Aquarian Connecticut portion with their actuary.
Okay, so that is late file exhibit 26. Are there any clarifying questions from the company?
Okay, thank you.
No clarifications. Thank you.
Thank you.
Okay, thank you. If you would now move on to reference RRU 18, which is pension assumptions. And just a point of reference here, is it correct that discount rate and return on plan assets have an inverse relationship to pension expense contribution? That is, the higher the discount rate, the higher the return on plan assets, the lower the expense and contribution would be?
I'm sorry, can you repeat that again?
Is it correct that discount rate and return on plan assets have an inverse relationship to the pension expense and contribution? So if either of those two go up, the contribution and expense will come down.
Yes, so the lower the discount rate, the higher the expense, the higher the salary, the return on assets, the lower.
Okay, so they're inverse, and then salary rate has a direct relationship. The higher the salary rate, the higher the contributions.
Correct.
And expense, okay. Just get that in the record. Regarding the historical assumptions, it appears in RRU 18 that the company is a little bit more conservative than the S&P 500 and the Aon client assumptions. Is that correct characterization?
Yeah, they're slightly different.
Different in the sense that they're, for example, the discount rate for the Aquarian is a little lower, which would make it more conservative, because we just said the higher the rate, it has an inverse relationship. So the lower the rate, the higher the expense.
Yes, I think in some years, so if you look at 2018, our discount rate is 4.46 and the S&P is 4.3.
Okay.
In other years, we're just slightly higher. In some cases, it's half of a basis points. And it's important to note that the discount rate we're using, at times, it's specific to the Aquarion plan, the liabilities and, sort of the cash flow that's needed to fund those payments. So it may not be exactly a match to the S&P 500, because that's looking at sort of the universe of plans. So I think it's reasonable to be slightly different.
Can the company explain why it's for the most part, a little bit more conservative than the benchmarks here, and indicate if the actuary has recommended that to the company based upon its funding status, for example? And second part, has the company made recommendations that the plan assumptions need to move more in line with those of the Aon clients, that their average?
The actuary does make the recommendations to us, again, based on our plan. And then we review it and discuss it and determine that it's reasonable. We have been pretty consistent with the salary scale that is reflective of our experience on, a whole basis, looking at merit increases and other payroll adjustments throughout the year. We have adjusted the return on assets from the past. I believe we were at 7.5% at one point. We're reduced that to 7%. And I believe that if you look at the long-term return of our plan assets in our portfolio, it's pretty right on, to that 7%.
And just to clarify, the discount rate now has some very strict parameters that must be followed. Is that correct? And those are set by the PBGC?
That is my understanding, yes.
So there's not much latitude that either the actuary has or the company on that particular assumption.
That's my understanding.
All right. Let's move on here to post-retirement medical retiree benefits. Again, my review of the record, I find that we do not have the FAS 106 post-retirement benefits document. So I would like to ask that be filed in the record. So Commissioner, that would be provide FAS 106 post-retirement benefits document.
And what was provide,
I'm
what was
sorry,
the word?
It's FAS 106 post-retirement benefits document, for any other word.
You should take administrative notice of that.
Okay, that's late file exhibit 27.
Okay, 27, thank you. Okay. And let's see, well, let's continue on here with RRU 21, which is, we have in response here that per RRU 22, the company is proposing $68,173 in retiree medical expense. Is it correct that the VEBA chart reflects the consolidated VEBA across all Aquarian companies? And by VEBA, that is vested employee benefit account, correct?
It's a voluntary
Voluntary.
employee benefit account association. It's a trust.
Okay. So it's a consolidated account across all the Aquarian companies?
Yeah, we have two VEBAs, one for union and one for non-union.
Now, in terms of the Aquarian medical retiree proposed the 68,000 and change, is that a portion of the actual VEBA contributions?
The 68,000 that's reflected on WPC 3.192 line 15 is the retiree medical expense.
Right.
The chart below on RRU 21 is the VEBA benefits paid from the trust.
Oh, okay. All right. So this is what you're paying out, and there's an expense associated with the retiree medical. Okay, should we move on to RRU 31? And you may have missed portion of the question. The question actually asked the company to compare the post-retirement benefit plan performance to the S&P 500 and to a post-retirement benefit pension benchmark, such as the New England Pension Consultants. Does the company not use such a benchmark?
We do not use that benchmark.
Do you use another benchmark similar?
We do not.
Oh, okay, so your only comparison is to the S&P 500?
Yes.
Or- Okay, why is that?
I just want to clarify that, like you mentioned, the New England Pension Consultants as a benchmark, but each of the underlying investments that we have in the portfolio, we do have a benchmark for each of those investments. I believe they were included in the SEI reports that were submitted by investment type.
Okay. And then, but there's no like, I think I saw those, they're by asset type, is that correct?
Right. So, there's whatever asset we have invested in, there's a
Mhm.
benchmark that could be a Russell, 500,
Okay.
whatever
So the-
SCI.
So the plan itself doesn't have like a composite benchmark that it compares to, or?
No, other than the assumption that we have, just like the pension plan that we're looking for in the longer term, a 7% return
Yeah.
on plan assets. But we don't have a specific benchmark for VBUS or, retiree medical plans that we look to because, again, the underlying investments can be very different plan by plan.
All right, so that part of the analysis has to be done on a investment asset class basis, is what you're saying?
Yes, so when we look again at the long-term expected return of the plan, we select investment options that we believe would get us to the long-term achievement of that ROA over a long period of time. And then we evaluate each investment to make sure that it's in line or performing on par with that benchmark. And to the extent that it's not, we would switch it out, for example, or modify it based on the status of the plan.
I would like to just kind of update our RU 31 to your most current information because you end here at 2021. Could we also update our RU 31 with the 2022 and later and provide that relevant document that would provide those breakdowns per asset class along with it if
So just to clarify, can we provide the October 31st month ending
Okay.
results for the plan?
Okay.
And the associated investment options?
Yes, yeah, that would be good.
We can do that.
Okay, so that would be a late file update, RU 31 through 2022 October with corresponding backup documentation on performance.
And Ms. Scaris, just to add some additional color to what Ms. Texera just responded to, if you were to take a look at attachment 1 within late file or within RRU 31, attachment 1,
Okay.
you'll see there we are indeed not only comparing actual performance against a benchmark for each of the individual investments. We're also we are doing it on a portfolio level where SCI is rolling up. So I'm on I think it's the third page under investment returns.
Yes, I see it.
And you can see for the 1 month, the total portfolio return for 1 month was 3.02. The index or benchmark for that period of time was 2.46. So we exceeded it for that 1 month. And then the detail is provided further below that schedule for each of the individual asset classes, whether it be equity or fixed income or whatnot, real estate, how each of those individual assets are performing against that benchmark. So we're seeing that there is reporting where we're getting that on a monthly basis. This is the detail report when we sit down with, as an investment committee, when we sit down with SCI to go over the returns of the plan. We're evaluating it both on an overall basis as well as the individual components as to how they're contributing to the overall performance of the plan.
Okay, so this, you'll be able to provide this for, through October? Okay, okay. Thank you. Okay. If we move on to RRU 32, please. Just the next one. Again, just to set the record, both the discount rate and the return on plan assets have an inverse relationship to the post-retirement benefit expense / contribution. And just confirm for me that the medical trend rate has a direct relationship. That is that the medical trend rate, the higher it is, the higher the post-retirement benefit expenses.
Correct.
Okay. Again, is it correct that the company's initial trend rate assumption of the 6.5 is higher and thus more conservative than the survey average of the 6.06?
That's correct.
Is there a reason that the company is going with a more conservative medical trend rate based? Is there any basis from the actuarial's recommendation?
The information is provided to us from our actuary, and we rely on that. Again, I think it's based on the design of our plan and our population. And I think it's more difficult to find comparative data for post-retirement medical benefit plans.
For example, with a more conservative medical trend rate, has the actuary indicated that maybe the plan participants are older and thus maybe having more medical problems that would lead to having a higher rate like that?
Well, these are pre-age 65 retirees. Since it could be a factor, based on our experience, but I'm not 100% certain of that.
Let me discuss with you, how often does the company and the actuary review the particular actuarial assumptions related to post-retirement benefit obligation plan? Is that also done quarterly or annually?
This is done on an annual basis.
Okay, and
And these factors are also reviewed by the auditors, for disclosure purposes. So they would, rely on the data valuation as recommended by the actuaries, that it's reflective of our population and it is appropriate for our plan.
And there's been no discussion with them that, or recommendation that that particular assumption needs to move more in line with those of the Willis Towers Watson client average?
They have not.
Okay, well, I think I'm all set with the pension portion of my cross-examination. I do have, don't think I have anything for OCC on that. I would like to move on now to questions on SERP expense. And we'll start with the SERP defined benefit portion, referring to responses to RRU 3, RRU 39. Also cross-reference to OCC 66, 67, 68, 69, RRU 445, and RRU 446. And a lot of this is some clarifying questions that I have. You may not need to read all of those, but is it correct that for the defined benefit portion of the SERP, the defined benefit pension plan has a limit set by IRS based upon employee salary? Is that correct?
That's correct.
And per RRU 45, the OCC provided that maximum level by the IRS code for qualified defined benefit plans as 265 for 2023, for example. Can you confirm those figures for me per the RRU 445? For example, 265 they have for 2023, 245,000 for 2022.
He's
Okay,
looking
take
it up
it
for me.
yeah.
Those figures sound right, but I just want to confirm.
Okay, thank you.
Those numbers are correct.
Okay, thank you. Now, in the application, the SERP portion related to defined benefit account is $13,746. Could you clarify that that amount relates to 3 people only? And that amount would be just the amount of salary above, for example, 2022, the $245,000 salary.
That's correct. There's 13 active participants, and then there's a small component of expense that would be the interest attributable to the participants that are collecting a benefit.
Okay. Per OCC 68, the company indicated that there are 3 active eligible employees in the defined benefit, the SERP, that are impacted by this SERP on the defined benefit side. Is that correct?
That's correct.
I thought you said 13.
No. I said there are some participants who are in pay status. And the way you calculate the expense is you still have to calculate a very small amount of interest
I
attributable
see.
to people that are collecting that benefit. But the majority of the expense is related to those employees that have a benefit and are in active service.
Okay. And so they're the active 3 that are contributing to this amount, and then there was an additional 8 retirees. Does that 13,746 amount just cover those 3 actives, or what about the 8 retired executives?
The way the expense is recorded on the books per accounting rules is that you have to record the expense related to retirement benefits while the employee is actively employed. The majority of that expense is therefore related to the 3 actives, but there is a small component that is considered interest that you have to calculate for those employees who are retired and collecting a benefit.
Okay, so they do come into play there, but
Yes,
very,
it's immaterial,
Yeah.
since most of the expense has to be recorded while they're actively employed.
so the company has proposed that this 14 amount, just under $14,000, be incorporated into customer rates. Is there a rationale why the company cannot pay for this without going into customer rates?
Well, it's considered a benefit, and the services that the eligible participants are providing, in managing the company and continuing this benefit to retain them is, we believe, should be included in rates.
And just to be clear, the IRS, the amount here, we're talking about an amount that exceeds what's legally allowable, right?
Under the qualified plan,
Right.
yes.
So unqualified plan, you wouldn't be able to take any tax deductions for that, right? Because it's unqualified.
I'm not sure about the accounting rules behind it. It's just that it's not allowed under the qualified plan.
Okay, so it becomes unqualified because it exceeds the limit of salary.
Correct.
Okay.
But again, the reason why you have these non-qualified plans is because when you're looking at the benefit that an employee, let's say there's an employee that makes $100,000 and the entire formula in the plan is captured and provided to that benefit. The nature of some of the executives that provide, important duties in an organization exceed that. You're disallowing that. You're including a lower percentage as a part of their total compensation, just because the IRS has that limit, which eliminates a benefit for an executive, which is why you have these non-qualified plans.
Well, it doesn't eliminate the benefit. The company has the option to fund that portion. Isn't that correct?
Correct, and that's why we have the non-qualified CERT plan to
Okay.
keep them whole, because the qualified plan does not allow for that.
Okay. If you turn to RRU 445 Part B, there was a portion of the question that OCC was not able to provide, and I would like to send that to the company to see if they can give us the answer to that. So there was a table I had requested for. Could you take a look at that and see if you can supplement the answer here so we have a understanding of and I can read it into the record. It says for each supplemental executive retirement plan, eligible employee provide a table that shows the amount of their respective salary exceeding the IRS limit, and the respective SERP expense. Is that a piece of information the company can provide for us?
We can certainly provide the table with the salary, the amount that exceeds the IRS salary limit. I assume you mean that as part of the qualified plan that exceeds.
Right, yeah, what's going into the SERP part?
And are you asking for the respective SERP expense by participant?
Yes.
I would have to ask
if we
the
could do it.
actuary because it's actuarially determined as
I
part of
see.
the defined benefit plan. It's not something the company calculates.
On a per person
On a
basis?
per person basis.
Okay.
It's provided to us at a consolidated level.
Okay, all right, well, that caveat, you could do what you can for us in response to this. So I would say late file update RRU 445, Part B, table of SERP defined benefit.
Okay, that's late file exhibit 29.
Thanks. And similar question with the SERP defined contribution portion. If you go back again to RRU 3, RRU 39, and OCC 267, there's a discussion here that defined contribution plan, that 401k plan, there's a limit set by the employer contribution on behalf of the employee, and this is, as I understand it, it's determined by the company's plan formula, which is presently for new employees, 100% employer match up to 6% of employee salary. Is that correct?
That's right.
Okay, so in RRU 446, the OCC identified that amount, indicating that the IRS maximum level is the lesser of 100% of compensation, or $61,000 for 2022. Could you just take a look at RRU 46 and confirm those amounts for me in terms of the salary, the compensation levels, limits?
Maximum deferred compensation limits appear to be correct.
Okay, so we're all set with that. Thank you. Now, just to clarify for me, let's take the $61,000 limit for 2022. Is this imply that together the employee portion and the employer portion cannot exceed the $61,000? Or is it the employee?
It's the employee deferral.
So your match plus let's say I'm the employee and I, whatever my salary is, I can contribute up to $61,000 into the defined contribution plan without hitting that limit?
It's based on your deferral, so it would not include the company match.
So it'd be whatever my salary is, I get 61,000, and the company can match an equivalent 61,000?
If somebody contribute,
Or is, I guess the question
up to
is,
that is limited because the company only matches up to 6% of
okay,
someone's compensation. So if anybody was contributing higher than 6%, it would be unmatched.
right, okay, let's say that, what I'm trying to get at is there's two partials here. There's a 6% salary match, right? And then the amount of salary that
Be deferred.
equates.
Mhm.
Yeah. So the question here is it together $122,000 that can go into this 401k plan and not hit the limit from the IRS, or is it just the 61,000? So what I'm asking is,
Subject to check, but I'm pretty sure that that is your own compensation, not the company match. That would,
okay,
when you sum the two pieces together, it can be higher than the 66. It's your own deferral. But I
So-
will, I think there's another test that you have to go through, if my memory serves me correctly. That if you add your deferral plus the company, there's another number that you can't exceed, but I would have to double check that.
Okay, well, if that's the case, subject to check, if I can do 61,000 and the company can match up to that, that is backing into the salary. I mean, we're looking at a salary of about $1 million and change. Is that correct?
Not exactly, because in the defined contribution, the amounts that you referenced earlier in the defined benefit plan, the 265, I believe is the number for this year or next year.
Right.
Once you hit that compensation level, your deferrals must cease.
I see.
So in most cases, all cases, our employees would never be able to reach that $66,000 contribution unless we allowed them to defer a significant part of their salary, which we limit our employees to 20% maximum.
Okay. I'm really curious, maybe we need to clarify that, the amount of salary that can be matched and deferred and matched, and what the salary is that we're talking about that hits this IRS limit.
Well, let's say a plan was structured where, it gets complicated because you have to pass an IRS test at the end of the year where the plan is non-discriminatory. So you cannot allow highly compensated employees to contribute more as a percentage in the group compared to the non-highly compensated. So if a non-highly compensated employee was making $100,000 and we didn't have a cap, they could contribute $66,000 of their salary if they chose to.
Oh, no.
But because we limit the amount that you can contribute and our highly compensated, a lot of our high compensated employees, the executive group, for example, once you get to the 245 or the 265 maximum allowed, you would stop contributing because you can't contribute more. Your salary is not recognized under this plan.
Wait a second. The 265, that applies to the defined benefit.
As well as the contribution as well.
Okay. So there are other factors here besides the 6% match.
Yes. So this is in this question, I'm not sure who responded to this, but this is the 66,000 is just one number that says a participant can't contribute more than 66,000. But if a plan is designed where you can only contribute, for example, 10%, and you go above, and your salary is more than 265,000, you would not be able to contribute to the plan once you hit that $265,000 salary level.
I see.
Irrespective of however much you've contributed. So let's say you've only contributed 20, if you contribute 10%, 22.5, and you're at 225,000, let's say the limit was 225, you would stop contributing. You would not be eligible to contribute into the plan any longer.
So essentially what you're saying is that for the defined contribution SERP portion, those limits from the IRS apply here, and any salary above that is
That's
would
correct.
move into this SERP portion.
That's exactly right. So it accounts for contributions above the 265.
Okay.
Because if we did not do that, anyone who earned more than that would not be able to contribute, their full amount that they've elected for the year just by the nature of the fact that their salary exceeds that IRS limit.
Okay. Okay. So the salary in question here is again set by the IRS limit. If you did not have that, there could be potential for even higher salaried employees moving, contributing to this SERP defined contribution portion, but that's not the case, is that
Correct.
right? Because of the limit. Okay, thank you. Is there any way we can, so in terms of a break-even salary where the SERP 401k kicks in, it's the IRS limits and,
Yes, and you also have to be a participant in the plan, and that
Yeah.
is, determined. It's a benefit that only certain people are entitled to.
right. Okay, this is a clarifying question. In RRU 3, the company indicated the SERP defined contribution expense to be the $26,613. But in I'm sorry, this is OCC 267, there's a proposal of $97,728 SERP 401k per line 3, Schedule 3.19, line 25. Can you explain which one is correct in terms of the SERP defined contribution request?
I just want to clarify, you were referring to RRU 3?
Yes, please. Well,
So
there's a $26,613 figure there. I guess how does that relate to the $97,728?
Just give me a moment to find that on the schedule.
I'm unable to locate a reconciliation for that. Can you perhaps get that as a late file?
Okay. Maybe just clarify the difference between the 26,613 and 97,728.
And these are values from RRU 3
Yes,
response?
please. RRU 3, and then we also have OCC 267. So maybe you could just say clarify difference RRU 3 with our OCC 267.
Okay, that is late file exhibit 30.
267. Okay, thanks. And this is more of a general question regarding the proposed 97,728. Can you explain why that was incorporated into that is the SERP 401k portion was incorporated into the 401k expense of Schedule 3.19? Why wasn't that kind of broken out?
The groupings on Schedule 3.19 correspond to how it's recorded in our general ledger, and there's not a separate general ledger account to isolate those.
Okay. Is that a company decision or?
Yes.
Yeah. Please turn to RRU 446, Part B. Again, there was a question out to the OCC, and I was hoping that the company could provide a response to that portion, which is update RRU 446 Part B, the SERP 401 eligible employees. Is this something that the company is able to provide? that is provide us a late file with the table for the SERP defined 401K portion as we did in the last question.
Yes, we can provide that.
Okay, so let me give you a title for that, Commissioner. It would be Update RRU 446, Part B, SERP 401K portion, eligible employees.
Okay, so it's late file exhibit 31,
Oh, was it 30 or
31.
31? And okay, if you would turn to OCC 268, this is again another clarification of terminology. The term non-SERP, is it correct that the use of this definition of non-SERP expense would be an example, 401K expenses that apply to the salary that is below the IRS limit? If not, then what is your definition there of?
So this was intended to be the difference between, as you pointed out, the SERP expense is recorded in the general ledger as one amount. And so this would be what remains in that SERP 401K expense account when we exclude the SERP-related 401K expense.
That are above the limit, right?
Yeah, so it relates to the earlier conversation as to whether that amount, whether it's the 97,000 or the 26,000. So it should be,
Oh.
when you add those two numbers together, it should equal what's in total in the general ledger.
Okay, so in total, it relates to
The 1,425,003 that's recorded on Schedule C 3.19. Or said another way, pending the resolution of late file 30, there may need to be, we'll need to confirm that what's reported in OCC 268 is accurate.
okay, why don't we throw that into late file 30 as a portion of it? So Commissioner, we'll have to add that to your late file 30 there to confirm OCC 268.
Okay, so late file exhibit 30 is revised to clarify and reconcile the difference between the values in RRU 3, OCC 267, and OCC 268.
Sounds good. All right, so let me just take a look here. I think I'm all set with the company here with the SERP expense. I do have a couple of questions for OCC's panel.
Okay, so you're finished with cross of
Yes, I
this
am.
panel?
Yes, for this panel, yep.
Okay, Mr. Path?
Hello again. This is Ryan Path, consultant with Pure Staff. I have a few questions and I've put them all into all the documents that I need. I've put together, so hopefully it'll be pretty efficient to go through. I think these first questions will likely be for Ms. Zabo and perhaps Mr. Unger. I'm beginning by putting up on the screen Schedule WPC 3.142, which provides information for the pro forma expense adjustment for software licenses and other IT-related costs. From this schedule, I would like to specifically discuss the portion I've highlighted, which is the software maintenance non-SAP section. The first line of this schedule shows the test year expense of $702,000 at the top and has 3 line items titled Office 365, for which there were $217,000 attributed to cybersecurity by Trinity Cyber, for which there's $90,000, and $40,000 for cloud backup. Do these 3 items added together, well, I'll just say it like this. These 3 items added together sum to roughly $348,000, which is the adjustment that's found there, correct?
That's correct.
And this $348,000 adjustment amount then feeds into the $719,000 pro forma increase, which is at the bottom of the schedule.
Correct.
Correct. Okay. And would it be correct to view these as the costs that the company believes are known and measurable incremental costs? And when I say incremental, I mean relative to the costs that the company incurred in the test year.
That's correct.
Okay. Could you go to slide 2, please? Thanks. So this next slide is the invoice support that was provided for the $217,000 figure, specifically for the Office 365 costs. My first question is, during the test year, did the company utilize any Microsoft Office products such as Word and Excel?
Yes.
And during the test year, did the company have any subscriptions with Microsoft or incur any other costs from Microsoft related to its use of these Microsoft Office products?
With regards to the implementation of Office 365, the first year of licensing is included in the implementation cost of the project. Once the 1 year expires, then you have to expense those licenses on an ongoing basis.
So would that be no, that there were no costs related to the use of the Microsoft products in the test year?
There were no costs in the O&M expenses. What was being described is the fact that the implementation includes use of those products in the first year, and that's capitalized as part of the implementation costs.
Okay, so the $217,000 that we see on the schedule, which is Office 365. So the Office 365 line item, which is $217,000, is that those are at least in part the subscriptions that you're providing to, or you're purchasing for the employees, correct?
Yes.
And are you saying that there were no costs related to there were no costs in the test year related to those subscriptions for employees for Office 365?
Can I read in? I just need to check when we implemented it, but I'm pretty sure, as you know, Ms. Zabo said, the first year of licenses are included in the capital costs and wouldn't be expensed. But I just need to verify when we implemented it because there could be a couple of months worth of expense. I just have to verify that.
So could we mark that as read in F? We'll provide that as soon as we have it.
Okay,
Thank you, Chairman.
And can you just describe in a little more detail when you say the first year is included in, can you just describe what you, elaborate on what you just said?
Sure. As a generally accepted accounting principles, when you're implementing a new project or IT that has licenses that are required as part of that implementation, you can capitalize the first year of licenses during that implementation as part of the project. Once the 1 year expires, the renewal of those licenses must be expensed.
So you capitalized the first year of costs.
Correct.
And so if you capitalize the first year of costs, when are they expensed?
The first year are, well, it would be expensed as part of the depreciation of that total asset, but there is no separate expense for the license during that first year.
Is it expensed as depreciation during the first year?
Yes, that's what I believe I just said, is it becomes a depreciable asset. And so, for example, if you're going to implement a project and it's $100,000 and 10,000 are part of licenses, so the total cost of the project would be 110, you would depreciate 110,000.
Oh, okay. So I guess I'm a little confused because if the company capitalized and expensed during the test year, the Office 365 costs, then shouldn't the company be backing out somehow those costs that they capitalized and expense, because aren't those capitalized and expense costs embedded in the test year already?
The costs associated with capital and depreciation are adjusted on a separate schedule. The comparison here is to the O&M expenses. So we're not making any adjustments on this schedule for any of the capitalized costs and depreciation because those are adjusted accordingly on the D schedules.
So the crux of my question is I want to make sure that the Office 365 costs that were incurred during the test year and are being recovered as part of the test year have been removed, because if they haven't, it would seem to me that you're double counting the Office 365 costs because you're including them here as an adjustment to the expenses.
The costs that are here for the adjustment are the annual license fees. That's an ongoing cost that will incur annually. That's what that 217,000 is. That's not implementation fees. So there are two separate costs related to the implementation of this new software. We have an ongoing annual subscription, which is what's provided there. We had zero comparable cost in the test year, which is why it's additive. And the costs in terms of the impact of capitalizing the implementation costs are reflected in the capital accounts and adjusted there.
So was the entire test year well, when you say there are no comparable costs, I'm having a little trouble understanding what you mean, because clearly the company was using Microsoft Office products during the test year. It's so standard, I can't imagine a company could function without doing that. Unless you're saying there were no costs related to Office 365 that are embedded in the test year, or that are related, or I should say, unless you're saying that there are no Office products, there are no costs related to Office products at all in the test year, I'm not understanding why well, let me phrase it like this. If there were any costs at all related to office products for the company's personnel during the test year, whether or not they were capitalized and expensed or expensed immediately, never capitalized, I believe that those would need to be backed out because the amounts that you have here, this $217,000, ties exactly to the invoice. And so you're saying the Office 365 subscriptions that you have as an invoice here are being added as an additive expense, dollar for dollar. And so my hopefully I'm coming across because I'm trying to be completely frank about what I'm trying to get at. But I'm trying to understand and quantify whether or not there were any costs related to the company's use of the Office products during the test year.
Right. And so just to clarify, the Office 365 licenses are new. So that's what we're seeing added here for costs that were not in the test year. The Microsoft products that we were using prior to that, to go back to Ms. Texera's statement earlier, we want to confirm when Office 365 was implemented. If it was implemented during the test year and we switched over to that product and those costs included access to the licenses that were capitalized, there wouldn't be any need to continue to pay our previous Microsoft license fees. So the clarification on that will occur when we do the read-in in order to determine at what date we switched over to Office 365. That's the key point to the question, right? At what point during the test year did we switch over to Office 365?
Well, not necessarily. The key point that I'm looking at is what were the total costs that the company incurred to use products that are available via Office 365. And so, for example, if you had a different subscription and it didn't have as much functionality as Office 365, but Office 365 encompassed functionality that your previous subscription had, and your previous subscription costs $100,000. In my mind, that $100,000 needs to be backed out, or else you're counting both that cost, which you don't need anymore, and this new cost. Does that make sense?
Yes.
Okay.
Which is why I think it's relevant to know at what point the cutover occurred.
I think that's relevant, but I also think that I think it's relevant in the sense of knowing what the costs related to Office 365 were if they were an increase from the previous cost. But my question's a little different than that, which is I'm not just looking for what the costs were attributable to Office 365 when you switched it over. I'm looking for what are the costs that the company paid for previous subscriptions or anything else that Office 365, the products that Office 365 encompassed, because
Chairman, just to clarify, to make sure we give Mr. Pfaff what he's looking for. So as I understand it, we've been asked to provide in read-in F would be, at what point was the cutover to the Office 365 for which we're seeking the incremental licenses that are shown in the rate year? Then I understand the second part of read-in F would be, are there any Office 365 expenses that were in the test year for which we're no longer using those? And your question is, should those be pro forma out of the rate year? So I think it's clear in terms of what you're looking for, but the witness would like a chance to be able to research that offline and try to provide that in read-in F. Would that be responsive, Mr. Pfaff, to what you're looking for?
I believe so, but just to make sure we're on the same page, what I would be looking for, and I think you said this, but I just an abundance of caution, I would be looking for all of the costs that the company incurred related to Microsoft products or other products that Office 365 would encompass that would no longer be necessary given their subscription to Office 365. Does that make sense?
Yes.
Okay.
Yes.
Excellent. Okay.
Okay.
Thank you. The next item I wanted to discuss was on that same invoice, which is on the second page. So the second slide. And this could be an easy answer potentially, but I wasn't certain if I was misinterpreting something. But the quantity of the subscriptions, and I had the Office 365 subscriptions highlighted. So one is for 390 subscriptions, one is for 10 subscriptions, and one is for E3, and one is for E5. I believe E5 is similar to E3, except for it has additional functionality. And my question is, why would the company purchase 400 subscriptions when the number of employees, I believe, in Mr. Morrissey's testimony was 323?
These licenses are for the entire organization. And then I believe that the IT costs are allocated out, to the subsidiaries.
That's correct. So our IT costs are subject to an allocation based on our methodology has been based on customer count.
Okay. And when you say they're for the entire organization, who besides?
So that would include our affiliates, so our Massachusetts and New Hampshire entities. And so you can see on Schedule 3.14, row 24, there's a portion of the IT costs that are allocated, 8.54%. That's allocated to our other affiliates, and it's done using a customer count.
Okay, so this pro forma expense increase which was on the first schedule that I showed of the 719,128. Not all of those costs are being sought for recovery in this case. That's accurate.
That's correct.
Okay.
It would be less than 8.54%. That's allocated to other entities.
Okay. One second. Okay. Well, related to that, and I'm just doing these calculations ad hoc, so we'll see how this goes. But there are 400 subscriptions that were purchased, and if we assume there are 320 Aquarian if we assume that 323 of these subscriptions are for Aquarian employees, then I believe that would be about 80% of the number of subscriptions that would be going to Aquarian employees. And you're saying that 8% of the costs are allocated to
So there's two factors there. The number of employees that you cited are the positions that are, I believe, currently filled. So the company also has a number of unopened positions, which we would, be purchasing licenses for those employees, as the intent is to fill those positions. So if we were to look at Schedule 3.2, where we have our total employee count, if all positions were filled, it would be 332 employees. So as a percentage of the 340, it's actually closer to 98%.
Of the 340. I'm not sure where you get 340.
Oh, I'm sorry. 400. So we'd be at 83% using the fully staffed headcount of 334 as a percentage of the 400.
Okay. I'm curious if the IT costs are allocated on headcount, which would also presumably be are there 400 employees, including your subsidiaries? Affiliates?
Do you know how many are at Mass New Hampshire?
There are less than 400, but I think we also provide access to certain contractors that, for example, that perform meter replacement programs for us. And the license, again, is subject to check, is by device. So some employees will have a desktop access and some might have also a tough book when they're in the field. So that explains the need for a higher number of licensed than actual employees.
Would it be possible to see a schedule of how these licenses are distributed amongst the different companies? Would that be something I was like?
Can we provide that as a late file, Chairman, Mr. Pfaff?
Yes,
Thank you.
Late file 32. Late file 32. Oh, provide a schedule for how Microsoft Office 365 licenses are distributed.
Could we go to, we can be done with that line of questioning and I don't have much more. Could you go to slide 4, please? So this is the Trinity cybersecurity invoice. And similar to my questions related to the Microsoft projects, I want to ask about these costs to ensure that they're truly incremental. So what I'd like to do is have you look at the benefits that you see there. And so those are the services that they're obviously the services that the company is getting from Trinity Cyber. And can you confirm that the company during the test year did not receive any of these benefits from either Trinity or any other vendor. In other words, everything that Trinity is providing is completely new to the company.
I can confirm that.
Excellent. And we can move on to the next page. Thanks. So this is related to cloud backup costs. And I have a similar question as I had with the other invoices, which is whether there were any cloud storage services in the test year. I will say that this was the one invoice of these three invoices, or of these three categories of costs, the Office 365, the cybersecurity, and the cloud storage costs. The cloud storage costs, I wasn't able to tie back the invoices exactly, but I want to ask. So I'll get to that in a second, but I want to ask: were there any cloud storage service costs incurred by the company during the test year?
Specific to Microsoft?
And not necessarily specific to Microsoft, but I guess that would be redundant to these costs. That we're doing the same types of cloud storage services that these costs would be doing.
No, there's no duplication. If we had any other cloud based backups, we would have separate invoices because it's subscription based on a particular software. And most of our backups are still provided in-house.
And so when you say there's no redundancies or duplications, are you also saying that this is a new cost that didn't occur until post-test year?
I would need to verify that as part of the original response, because this backup would be directly correlated to the Office 365 implementation, which I believe is being backed up in the cloud.
Okay, well, if we can get that incorporated into that other late filed exhibit, so it would include this service as well.
And just to clarify, we're going to add that to read in F, where we were asked the questions about Office 365, and we'll add that as a subpart to that. Thank you.
Very good.
And my final question related to this, and the final question that I have is that, like I said before, I was not able to tie out the invoice to the 40,603 that was noted on WPC-314 Prince 2. So if possible, I'd like to get that provided as a late filed exhibit as well. And that would be, I have a title for it. That would be a reconciliation of Schedule WPC-3.14 Prince 2 to OCC-184 Attachment 4.
Just ask the witness panel, is it clear in terms of what he's looking for, and can we provide that?
Yes, it's clear.
And just one related question, Chairman, and that is, I want to ask the witnesses, can they produce that as part of a read-in, or would you like the chair's permission to do that in a late file, just based on what's involved in that request?
My preference would be a late file. If, however, we're able to accumulate it at the same time we're doing the read-in, we could address it at that point. I'm just not confident that we can provide it as a read-in.
Okay, let's mark it as late file exhibit 33 for now. Proceed. Is that it?
Those are all my questions.
Okay.
Thank you.
Very good. Let's go ahead and take our lunch break. So we will return at 1:10.
are you, Lisa?
I'm fine, thank you.
Yeah, out here, walking or something.
Yep.
You say it's beautiful out there? It's like,
Yeah.
I love it. Was there.
I love
Like, how about your horses? They like that?
They do. Oh, no, I'm not the weekend tomorrow. I have a day off. Thursday. Sorry, you guys.
That's good, you get a day off, I heard that.
Yeah, that's good. See if we can get it here. Are you all set? Nope, I'm all set, thank you. Have a wonderful day. Yeah, there's another report. Oh, my gosh. Okay. Take care. You too. Nice seeing you.
Yes, they will. They will sit here and, so I did, right? Okay. Well, then they're just gonna go down. Okay. And, great. Okay. Okay.
Have my information, if you have any questions, let me know, okay? Well, thank you. That should translation plan. Okay, they're ending early. Okay. So, all right, yeah, all right, and now I'm gonna let you know our last meeting number is, okay. Okay, any questions? Okay?
I know, I thought. Was. It's not very so they stopped.
Nice to meet you. Thank you for being available today.
just, terrible.
Oh, did you?
Yeah, well, you know, I heard, for a year or two, to 27.
Oh, yeah.
Up tight to the bone there. Yeah. Huh. You know, working. He's paid that. For 3 years. I've done now. Two. So.
Oh, yeah, but yeah, but I appreciate it. That's awesome. I appreciate it. It's just see it like there is a lag. There's a 30-second lag. Well, it doesn't stop it. It's like it's not like the broadcast where they forcefully do the 30-second lag. So I like when the accident happens, you can cut it off before. For me, if I cut it off right away, you still see it. It's just 30 seconds later, whatever it is.
Oh, yeah.
Yeah. Yeah. Yeah, like I was saying this morning. You guys want to try something there. That's great. That's all right. Yeah. But that's like I actually asked, it's like the childcare. Like I think that's we should be. I mean,
Good.
Where'd you go?
I've left my tag upstairs.
Uh-oh.
I think everybody knows my face.
Who is that?
Yeah. Straightforward cross. It's caged. Exactly. So are we just, does it have to have bars? Like, like a chimpanzee. Like it's yes, not. I'm there. Yeah. Cool. Actually going on Saturday. See the show. I've been going a little bit. No, at Hartford at the Webster. You guys can make it on fire. You're really one of those bands.
See a lot of them. I like it. I was like, oh, that's something
Good one. I thought Judas Priest. I'm not a big fan, but I felt like since I'm not such a fan of like everything that they created, I felt like and also some Rob Halford things. That created too, so I was like, all right, so that I can say I've been.
It's sort of third row thing, and then COVID.
Huh?
And I'm not a fan of alcohol.
Yeah, they were.
You get it.
Yeah, then they were awesome. They did came out on the motorcycle, like they did the whole thing. They did their whole thing, so it was good. And they were like, it was the kind of thing where like they're just so good. Like, they've been playing so long that even if you're not into the thing, you're in the music and all that kind of thing. These guys are very good at what it is that you're trying to accomplish.
Okay, if we, welcome back from lunch, we'll go back on the record. And I think we'll see if we can start with the read in E and F.
Read in E, what was the request for the bad debt write-offs excluding 2020 and 21 from the calculation? Ms. Zabo, can you proceed to provide an answer to that read in?
Yes, so the 5-year average write-off for the period 2015 through 2019 is 290,359. That's comparable to the 166,000 which we have in the case, and also in comparison to the 326,000 year-to-date net write-off experience that we reported earlier through October 2022.
Very good. Thank you.
And just as another point of clarification, what's relevant in looking at those numbers is it's certainly our historical experience in terms of net write-offs. But what that fails to really take into consideration is the growth in our over 90 aged AR. So if we looked at the end of 2019, our aged AR over 90 was about 11% of our receivable balance. And at the end of October of '22, that number has grown to 31.5%. And so it's the unknown in terms of what the net write-off experience will be as a result of the deterioration in the aged AR.
Thank you.
Okay, and Chairman, Read in F had three parts to it, and that was requested by Pura's consultant, Mr. Pfaff, as it related to Microsoft Office and the new software licenses, and also there was a question regarding cloud-based backup incremental expense. And after discussing it over the lunch break, we'd like permission to be able to roll that into late file 32. Late file 32 was the request from the consultant that we show actually how the Office 365 licenses are being distributed among our personnel. And so do we have permission to take that Read in F, roll that into late file 32, and then provide a written response?
Yes.
Thank you,
So
Chairman.
we'll add that to late file exhibit 32. Thank you. Okay, so with that, we can resume cross-examination of this panel. Mr. Zabowski, please.
Good afternoon, Albert Zablowski, Pura staff. Could we please turn to OCC 19? This is dues industry associations. Would you describe these as discretionary from the ratepayer point of view?
I would characterize these as dues to industry-related organizations that the company considers to be important and necessary, in order to ensure that our employees are educated and knowledgeable in industry-related matters, which in turn benefits the customers.
And can the company quantify the benefit to the ratepayer here? Not qualify, but quantify?
I don't know that I'm able to put a dollar figure on it, because it's almost as though the exercise would be to quantify what would be the cost of not providing this. And I'm not able to do that.
Okay, and there seems to be a percentage of one of these items on the list here, at least, that's related to lobbying. Is there a ratepayer benefit to that one?
So in Part C, referencing the NAWC notes on their invoice that 9% of their dues are related to lobbying activities.
So that does seem more like a shareholder benefit rather than the ratepayer, would you say?
Oh, not necessarily. I think there are some lobbying activities that benefit the customer. For example, we were able to repeal the sales tax recently. That is a significant benefit to customers.
Okay, and then in reverse, what would be some examples of how that benefits the shareholder?
I mean that the repeal of the sales tax it's a pass. There's a reduction in expense as well. But I would say that the customer also benefits.
Okay, thank you. Could we please turn to OCC 20? And these are dues for non-industry. Again, similar question, I guess. Is there any proof that the company can provide to quantify these expenses as a benefit to the ratepayer?
I would say the benefit to the ratepayer again is qualitative. I'm not able to quantify what the cost would be or detriment to a customer if we didn't engage in these activities. These are organizations that are in our service territories that the company supports, that our customers engage in as well.
So differently, outside of qualitative factors mentioned, there's no real way to quantitatively support benefit to the ratepayer.
Yeah, if I can add to Ms. Abo's response, I think there are some definite quantitative benefits associated with supporting these organizations. Again, most of these organizations that are listed here have to do with creating a vibrant economy here within the state. And again, we're providing water service in 7 of the 8 counties across the state. We are operating in a fixed cost business, and to the extent that we can develop the economic activity and we're able to add additional activity, whether it's residential usage, commercial, industrial, all of those things are beneficial, and that benefit will be spread across the entire our entire customer base. So I do think, whereas it's very difficult to quantify, I think there are quantitative economic benefits to our customers by supporting these organizations.
May I ask a follow-up question? I imagine each of these organizations host events throughout the year. Is that accurate? Or otherwise display the members of the organizations or supporting partners, or however each of them would describe?
Most definitely. I think the majority of them would have such events.
And in your experience, when they host those events, is the description of the member listed as Aquarion?
I think it depends, if we were to, for example, if we were to select something like the Bridgeport Regional Business Council or some of these organizations, you may target and have one organization support a specific luncheon or an event, and they would have, some displays there. My guess, based upon recollection, there probably is a banner somewhere that would display all of the supporting organizations or the organizations supporting that respective Chamber of Commerce or the like.
Thank you. In addition to the amounts that are shown on the screen, does the company shareholder contribute any portion of the membership dues to these organizations, or are the dues or fees fully recovered through rates?
Depending upon I'm not sure what was recovered in the last regulatory proceedings, but to the extent that these amounts have gone up or down, obviously that's been on the shareholders nickel. I believe what we've included here is the entire fee as part of recovering. Is that correct?
That's correct.
Yeah.
Okay, thank you. So in any instance when there is an event held or the sponsorship flags are shown or displayed, does it ever indicate that Aquarion ratepayers are the member, or is it Aquarion the company?
To my knowledge, it will just display the company's name.
Thank you. And last question before I turn it back over. Does the company ascribe or quantify a goodwill? Let me ask it this way. Does the company quantify goodwill advertising or goodwill marketing or goodwill communications in anything that you do? Do you put a dollar amount on what might be described as goodwill?
I'm not sure I understand the term goodwill, how you're using it in that context.
Sure. So any marketing, communications, advertising, sponsorships, et cetera, that are intended to primarily or in part engender positive customer reception to the company. Do you put a dollar value on the company's goodwill.
Well, let me begin by saying that the company does not, for the most part, market. We're not, and there was some responses provided as part of the discovery. We're not incurring marketing expenses or advertising expenses. Largely what we do is we are trying to educate our customers. And I'm sure we may get into some more of this line of questioning in a few moments. We're trying to help educate our customers in terms of how to conserve and really to help us control their usage and demands of the system.
Great, thank you, Mr. Zabowski.
So for both of these now, industry association dues and non-industry, does the company control how much it pays for these, as in, are the amounts listed here, the amounts the company has to pay, or it chooses to, I don't want to say donate, but I was wondering if that's a part of it.
My understanding is that the dues to join these organizations are fixed for the basic, benefits that are received from those organizations.
And those are the amounts that are listed here?
Yes.
And that is the same for Advanced CT?
Repeat that, please.
Advanced Connecticut? This is on OCC
Advanced
20, the last item for $30,000.
I believe so, but I would have to double check that.
Okay, well, if we turn to OCC 21, this is the interrogatory on Advanced CT, Advanced Connecticut. If you look at what has been paid for by the ratepayer from 2017 to 2021, this amount varies greatly, from $22,500 to $30,000. This does not seem like a fixed cost, or are you saying that in 2017, the entry point was $30,000 and then it dropped in 2019 to $22,500? It seems more discretionary, I guess, than fixed.
Well, the majority of the years were at 30,000. I would have to understand what the differences were in 18 and 19 to be honest in my response. I'm not sure what caused those 2 years to be slightly lower.
Okay, sure. Can we get that as a read-in?
Of course, so we will make that read-in G, and to the extent that we're not able to provide that as a read-in, we can revisit a late file number. Thank you.
Thank you. And the reason why I'm really asking that is that if they are not fixed cost, then I'm not sure applying an inflation factor of 10.6% applies here. Now, for industry dues that are fixed, I can certainly understand that they will go up in price over time. That being said, for amounts that are variable, where the company can use some discretion to pay however much it wants for these, such as Advanced CT, assuming that's the case here, obviously, then I'm not sure an inflation factor of 10.65% would be appropriate. Okay, moving on. Can we move on to OCC 65? This is for location expense, please. So during the test year, $22,500 of relocation expense was recorded. How many people is this for?
One person.
One person? Okay. And how long does this employee stay at the company?
This position, he did not stay at the company for very long,
So is this like a month, 2, 3, half a year?
about half a year.
Half a year, okay. Is there no clawback provisions on this expense? So could the company go after the employee? There's nothing in the contract that says if you don't implement contract, but if you don't stay for so and so, we can recoup this amount?
There was no clawback
No?
provision.
Okay. Does the company anticipate adding one in?
We will consider doing that.
Okay, so if you do add one in the future, then this expense doesn't really belong in the test year going forward, assuming there is a clawback provision in the contract, correct?
Well, no, I mean, if we do relocate someone and they stay, then it
Then,
would be an expense of the company.
In that scenario, yes, correct. Thank you. And on the other hand, what certainty is there that you will have a relocation expense in the future?
Well, in the current market that we have, and when you're trying to recruit someone, especially at a higher level in the organization, I believe it's more likely that we will be incurring these expenses, as historically, we don't utilize this expense very often, but it does happen, and I believe the probability will increase due to the lack of qualified candidates that are in the marketplace.
And does the company believe this period is going to last until its next rate case?
Likely, even though you may hear there's recession coming,
Sure.
all the data indicates that unemployment will continue to stay low, and that qualified candidates are still very difficult to find, especially in certain areas.
Okay, and without telling me too much about this employee, $22,500 seems, well, at least to me, a bit steep for a location. Was this basically cross-country?
It wasn't cross-country, was several states away.
Okay.
And it included, just hiring a moving truck as, upwards of $10,000.
Okay,
So I believe this amount is competitive.
okay, thank you for that. Can we move on to,
I'm sorry to interrupt. Can I just ask you to elaborate on your belief that this amount was a competitive? Did was the employee required to submit any competing estimates for a $10,000? Did they submit multiple estimates? How did you verify that this was a competitive amount?
It was based on, just understanding the moving truck expenses from people that I've heard, about, moving from place to place, renting a home while they're moving from one place to another. So there's a number of expenses incurred by that candidate that would be included in that amount.
Okay, so the evidence was anecdotal. You don't have any estimates provided by multiple vendors?
I do not.
Okay, thank you.
okay, thank you. Let's take a look at OCC 25, please, entertainment and sponsorships. For the for the two items listed here, the first one is the Webster Bank Arena Suite for $25,000. What was this event for?
The Webster Bank Arena and the Hartford Healthcare Amphitheater are memberships to allow people to attend venues that are held there.
Okay, so this is accessible by all employees?
Yes.
Okay. And so the $25,000, is this essentially a once a year sort
Yes.
of so it was one date, if you will? in
It's
the
a
year?
one-time payment that would
One-time payment.
allow entry into the venues that are held there throughout the year.
Okay, thank you. And is there a more detailed breakdown of these expenses or bills, if you will, that the authority could see, or is this just a one
It's a
line item?
it's a one-time payment.
Okay, all right.
I just want to clear, when you say one time, you say, is it I'm just a little unclear, is 25,000 a year or one-time payment?
A year.
Okay, just want to clarify that.
And just one last question on OCC 125, the redacted version. So, if you look at the company's response, second paragraph, which states, the company has historically allocated an annual sum of $50,000 to the program, and this is the customer assistant program. However, in 2021, the company expanded the program due to the pandemic, incurring a total cost of $165,821. Does the company anticipate to keep this program cost at this level going forward?
No, we believe that the program will normalize, once we get through the post-COVID period of time. And we are recommending that this expense be included in our rate base, as historically this has not been.
Thank you. I think that's all I have.
Thank you. Ms. Piedamonte?
Good afternoon, Kathy Piedamonte, Pura staff. Following up on a conversation that the panel had with the chair yesterday regarding communications. What is the total amount spent on all communications, including those that have to do with the water conservation and those other types of communications that Mr. Morrissey mentioned?
I'm just going to take a minute to try and recall which response I think would be most suitable to reference. So if you were to refer to EOE 66, attachment 1, this shows communication-related costs in the two categories that we had discussed. One that was associated with communication specific to conservation. That's on the second table. And in 2021, the company incurred costs of $390,469. And if we were to combine that with the communication costs in the table above that, which are general communications to our customer set of $432,000, the total would be $656,417 in the test year.
Okay, I have a question about something you just said here. That 432,000 shows as budget. There's line above that, expensed.
Yes, I'm sorry. I communicated the wrong number, but the total is the 265 plus the 390 to get you to the 656.
So your total communications expense for a year is the 656,000, correct?
Those are, yes, I'm just going to clarify and say that those are the costs, because in our test year, only a portion of them were expensed.
Correct, the 265, yes?
Correct, yes.
And where does that show up in your C schedules?
Just give me 1 second to reconcile that. So you'll see on the budget line there where there's 3 accounts listed, 930-209, 930-211, and 923-214.
Mhm.
I'm going to call up each one of those and reference where each one of those appear in the C schedules.
Great, thank
So
you.
the 930-209 account appears in the category of expenses on schedule 319, as they were adjusted, they were included in the category of expenses that we adjusted for inflation. And then the 930-211 is in that same category as well.
And did you mention the name of that category? I'm sorry.
I'm sorry, it's the costs that are subject to inflation.
Okay. That 319 has many different items listed, if I remember correctly.
Yes, okay, so I'll do the last account here, and then
Okay.
we'll- and then we'll go to that schedule and look it up over there too.
Thank you.
So those 2 accounts would be on there, and then this last one, 923-214, is in that same schedule as well. So let me go over to the 319 schedule, and I'll find you which line item they appear on. So the 930-209, 930-211 are part of the subtotal on row 36 of the miscellaneous account. And the 923-214 is part of the subtotal on row 21, which is other consulting.
Consulting, okay. So it appears that those are likely inflated by the 10 point.
Yes.
Okay. And I hate to ask you this, but do you have the breakdown for each of those accounts that would total that 265 number?
Unfortunately, I don't on this schedule. The majority of the costs are in account, the 923-214 account, which is outside services costs. So it includes expenses in addition to just these communication related expenses.
Okay.
So if we reference EOE 68, which has a breakdown of third-party entities retained for advertising, marketing, or communications, I see a large, probably the second largest chunk of money in this table is directed to Gaffney Bennett, who provides what's listed here as public relations. Can someone, maybe this was maybe where you're going.
Don't go right.
Is public relations the primary business of Gaffney Bennett, or is it lobbying?
I'm not sure what their primary function is, but we do not use Gaffney Bennett for lobbying.
Okay, can you provide any more commentary about what constitutes public relations?
They supplement our corporate communications group, which is a very small group with regards to things like press releases, advisement on communication, development of communication materials and the like with regards to things like our environmental champions program, those types of services.
Okay, and the environmental champions, that's an award that has been given out for a number of years.
Yes.
And that is funded solely by ratepayers, that program and the award and the advertisement around that. Is that accurate?
Yes, those costs have been included in our recurring costs.
Right, okay, thank you. Ms. Piemonte, you can continue, I apologize.
Thank you. Okay, that was my next question. So moving on to OCC 151, please. And also referencing Schedule C-3.7. Here you have revised the numbers related to the conservation costs. And you have recalculated the activity that occurs between 1/1/22 and 12/31/22, which would be the amortization of costs. Is that correct?
That's correct.
Okay. In C 3.7, it shows, and this is WPC 3.7, you're showing a 5-year average cost related to conservation of $453,000. And now in OCC 151, it's been recalculated to $512,439. So is that still a 5-year average that you're using?
So if you take a look at OCC 151 attachment 1, on the second tab of the Excel document, we have switched the average to a 4-year average because we were beginning the program. So we've realized that it was more reasonable to do a 4-year average instead of a 5-year average.
So the 4-year average is 2021 and going back?
Correct. And it would have included 2017.
Okay, so 2017.
Would be the 5-year average, but the 4-year average would be 2018 through 2021.
Okay. And the correction of $17,788 would be what specifically?
So when we were reviewing the information, we realized that there were certain costs that should not have been included in the deferred account, and we removed them.
Okay. So that's the correction and the adjustment numbers that are
Correct.
shown? Okay.
So then the attachments to OCC 151 will back up the numbers that are included in the deferred account at this time.
Okay. And still using the 6-year amortization period for all of those deferred costs?
That's what we're recommending. Yes.
That is all that I have. Thank you.
Thank you. Okay, have I got all authority staff? Think so. Okay, Attorney Marshall. Any cross from deep? Thank you. Then we will transition to the Office of Consumer Counsel, please.
Thank you, Madam Chair. We'll start with cross from John DeFever.
My cross is about the incentive comp. Now, I believe I read the employees receive 0 to 200% of target. Is that correct?
The plan allows for that, yes.
What percentage is used for budgeting?
100% we use for budgeting purposes.
Okay. Now, I heard earlier the 70-30 split between financial goals and operation, that's only a trigger, correct?
That's correct.
Is that used to determine whether the company has sufficient funds to pay the incentive comp?
Yes.
Okay, if it's used to determine if there's sufficient funds, why are there operation goals? How would they contribute to the funds?
Well, we want to make sure that there's a financial and then there's operational, as you know. We want to make sure that there's sufficient funds to fund the plan. And then there are metrics that employees specifically focus on in order to ensure that we provide great customer service, water quality, that we operate safely. And when you look at the funding of the plan, it's under both of those categories. And then the actual payout is dependent on the employee performance and the attainment of their own separate goals.
Okay, well, I was asking, like the 70-30, is that used to determine whether you have enough cash to actually pay the employees? Is that, or enough funds to pay the employees? That's not what you're saying?
Well, yes, you have to have enough financial, success in order to fund the plan.
Right, but that would only be the 70 then, not the 30?
Yes, that's the component of the architecture of the plan.
Right. Yeah, I'm having trouble understanding how if the 30 part, the operation goals are also used to determine whether there's enough funds, how would operation goals contribute to the funds?
Because the generation of 100% for the 100% pool of money is dependent on financial as well as the operational metrics. You're never going to get to that 100% if you don't achieve the operational metrics as well. So the combination of those components generate the pool of dollars that are then allocated to the employees.
Okay. And the pool of dollars, that's not related to the 70-30. That's a separate thing? The size of the pool? Or is that how it's determined?
It's determined and then it's based on employees' salaries and the percentage that each employee is attributable, would be able to receive in payment.
Right, but the size of the pool, I presume that's the total amount that's being paid in incentive comp.
Yes,
Okay, and that's determined by the 70-30 split?
the attainment of the total pool is based on both the attainment of the financial and the operational. So like, for example, when you're budgeting this and you have to take into account all of your employees, what their base pay, what their target, you generate a dollar that you would budget for. And then when you're reconciling your goals, both financial and operational, the actual attainment will say if you've only attained 80%, your whatever dollars you budget get reduced by that. Correspondingly, if you achieved greater success than what you've planned for, it would generate a higher dollar.
Okay, but on the company level, let's say, for example, if I achieve all my goals, I'm gonna get 100,000. If the company does the 70-30 split affect that, the initial trigger?
In the individual employee, when they're evaluated, it's not a 70-30 calculation. Is again, you've now attained consolidated results that generate that pool of money. But then when you're evaluating that employee, you don't say, oh, you've achieved 30% or 70%. That's why I believe in your rebuttal, you've suggested the removal of 70% of the incentive comp, and I think that would be a detriment to a majority of the employees who don't have a direct influence on the profits of the organization.
Right.
But and then we have managers, for example, or directors that do have responsibilities for achieving their budgets, their department budgets, whatever they're responsible for. So I would say they have responsibilities for financial due diligence, and the attainment and achievement of those goals do benefit customers because it would then elongate our need to come in for rates, if everybody delivers on the organizational objectives.
Okay, I'm having a hard time getting this question across, I'm sorry. So you say a pool is generated. Now, for the employee that's supposed to receive 100,000 if he meets all his marks, is that decide that pool affect that? You see what I'm saying? You say a pool is generated and that's what they're gonna pay everybody with.
Mm-hmm.
So does that affect the amount that the individuals get? Or is that a predetermined amount?
Well, there's targets that are established based on your level of in the organization. Whether
Right, but I'm saying if you hit, I'm sorry to interrupt, but I'm sorry, if you hit all your goals, is your max amount affected by the size of the pool, or is it?
Yes, the maximum amount would be limited, but it is allocated out, to the employees based on their contributions to the success of those goals.
Right, so if the company had a great year, incentive comp would be better than if the company had a bad year financially.
Yes, if the dollar pool is less,
Yeah.
then yes, that would there would be a similar relationship.
Okay,
The payout.
thank you. Now let's get to the goals themselves. If let's say the 70% of financial goals are met, but the 30%, the operation goals are not met, does that affect the payout
Yes.
by the same amount?
There's a percentage allocated to each specific goal that again would contribute to the development of that total pool of dollars.
Okay, so let's say I was supposed to get 100,000 of incentive comp, let's say in this scenario. If the financial goals were met, but the operational goals were not met, then I would get 70,000?
You would, the dollar pools of dollars would be about 70%. And then that amount is allocated to the employees based on the pool of dollars that you have
Yeah.
and the target level of compensation that each position would have.
So it may not be exactly 70%, but I mean ballpark, if you've shrunk the entire thing by 30%, then everybody is taking a hit by that amount.
Likely, yes.
Okay, now what about the reciprocal? Let's say the financial goals are not met, but the operation goals are met. Is there still a payout?
Yes.
But it's just a 30%.
If going by the straight formula, yes, although that can be adjusted based on how well you've achieved those.
Like
goals.
on an individual basis, but the pool is 30%. I mean, yeah, it's 30% of what it would be
Yes.
if the financial goals are not met. Okay, thank you. I read that the incentive comp does motivate, employees are motivated by the variable pay structure
I believe
at your
they are.
position.
Yes.
Do you have any support for that? Any studies or analysis?
Well, I have studies that show that our customers are extremely satisfied with our service, where 94% of our employees, our customers rate us as very good, very good, or excellent. That's one of the key metrics in our plan. We have a great record on our product quality. We incentivize, try to focus our employees on being safe. We've have a good record of that, very good record of that. So we believe that putting a portion of someone's compensation at risk does motivate people to focus on things that are important to the organization. And I think you can see that in the history of our company. That's been our philosophy as far back as I can remember. Alternatively, we could move a piece of the incentive comment to base pay. We don't want to do that because how would that incentivize people to perform? And we need to be competitive with the market. Not every, but many utilities and many organizations have this type of pay structure. And it's important for us to continue to have this in order to attract and retain employees to the organization. And I firmly believe that this has motivated employees to perform rather than just, again, revert to a base pay type of philosophy where you're paying people, and hope that they achieve the goals of the organization.
Okay, thank you. But you don't have any support, like that's your belief, but you don't have anything that ties, like you're saying you have these great successes, but you don't have anything to tie those to show that they're a result of the incentive pay program.
Well, it's qualitative results, that you can see from our operational efficiency numbers, where we can show that we are very efficient. Our customer service results. I personally and professionally don't know of any survey that can say, if you have this type of compensation, these are the results that you can articulate. If you have something that we can utilize, I'm more than happy to look at it and to implement it and compare it to what we do. But we have a lot of data to support the fact that we run a very efficient operation and we provide, I would say, excellent customer service. We have great employees that really care about everything that they do. And we think that our compensation structure is aligned to motivate those behaviors.
Right, well, thank you. I understand that's a theory. I'm just trying to see, if there's anything to tie it in.
Chairman, I think the witness has answered the question. She's identified the support that the company is relying upon to support their conclusion that the program is effective and incents employees.
Okay, Attorney Wheel, do you want to be heard?
I just say if that's the company's best answer, then we'll accept that.
Okay, thank you.
Okay, that's all I have. Thank you.
Thank you.
Thank you. Good afternoon, Richard Sobolewski with the Office of Consumer Counsel. I have a few questions on pensions. this morning, I know there was testimony given when Pura staff was doing cross, that the company was trying to fully fund the pension fund. Okay, so there were certain instances where you were making contributions that were above, the minimum requirement. In the last rate case, I was looking through that before at the break. I believe the company was allowed around $5 million in pension expenses the last rate case.
Just double checking that. I assume that the number you said is correct, but Mr. Unger's verifying that.
I think it was about 5.127 million, and Pura made some slight, or maybe it was a little more than that. Pura made a slight adjustment for one of the assumptions. And he brought it down to just over 5 million.
I'll accept that subject to check.
Okay. And I know this morning there was an OCC interrogatory that showed what the expense was annually since basically the last rate case. And I understand that, you know, your contribution and your expense is not one and the same thing. Is the company able to provide an exhibit to show what the contributions it made on an annual basis since the last rate case? If it's not on the record already.
We'll provide it. I think that there have been, there's a schedule that shows that, but it may not have gone back to 2013.
Okay, so that would be lay file exhibit 34.
And I saw the test year was less than $2 million, the expense.
That's correct.
And is that what's carried forward going forward?
Yes.
Thank you. That's all I have.
Very good, thank you.
Hello, I think I've already introduced myself to you guys a couple times, but just in case, my name is Tom Wheel. I'm a staff attorney with the OCC. And my questions are unfortunately a little all over the place in terms of subject matter, but I'll start. I hate to do this to you, Ms. Texera, but I have a couple more questions about the employee incentive comp. And they're really just clarifying questions. So I'm going to ask, just for the sake of understanding your testimony a minute ago, just going to ask some clarifying questions using a hypothetical employee X whose compensation package under this hypothetical would align with incentive comp of $100,000, just to keep things simple. You were testifying earlier that the step one to the kind of putting the program together is to figure out the total budget, the total amount to budget for, and you do that by looking at different compensation levels, and that's how you determine your total. So in order to derive that, you would have individual employees who could earn particular amounts. So you could have hypothetically an employee X who could earn $100,000 in incentive comp as part of that step one.
Very few.
Sure, I understand. Just for everyone's clarification, I understand. I'm just using 100 because it's an easy number to.
I understand.
So my first question is, I think what you testified before is that, so you get this total pool that's derived from adding up all of those individual measurements. And then you look at the company's progress towards those goals, the financial, 70% financial and 30% kind of performance-based goals. And then that pool, not that individual $100,000 per se, although it's affected, but the first step is you adjust that total pool in accordance with the results of the performance results. So if you meet 100%, if you hit a 70% and 30%, then you do nothing to adjust that budget that you started with. Is that right? Because because you're at, that's 100% of your budget. But if the company did really well and you're at 130% of those total goals, then you'd increase that total pool 30%, and then that would have a corresponding effect on employee X at some point.
It could, yes.
Okay, I'll get to that part in a second, but first I just want to understand so the adjustment is based on the kind of the 100% allocation, meaning the adjustment you make to the pool is sort of looking at the whole pie, both the financial side and the operational side. So hypothetically, if you only met 60% on the financial side, but 30% on the operational side, you'd end up with 90% total of the goal you meet, and you'd have to lower down that pool by 10%. Is that accurate? The total
Yeah,
pool?
you would, if you only achieve, you said 70%?
60% of not 60% of the financial, because I'm not talking about 60% of the 70%, but if you only met the 60% mark of the possible 70% of the financial side of the goal, but then you met the entirety of your operational side, so you got all 30% on that side, you'd have a total of 90% of your total goal met, right?
Well, you would take 60% of the 70%, and that's what would be attributable to financials. And if you met 100% of the 30, you would include 30%, and that's
Yeah.
how you generate the pool of dollars.
Understood. I think we're saying the same thing, but you're just using more advanced math than I am. So, because I think what I'm getting at by 60% using your terms would be something more like 6 out of 7 is what I'm referring to. Or actually, yeah. But I think I understand what you mean is that you would take the ratio, I guess the fraction of whatever you meet on either side, add those together, and that's your overall metric by which you adjust the total pool, right?
Correct.
So does it matter at all for that process, for the adjustment to that total pool, which side, the financial side or the operational side, is above or under the original goal?
Well, the 70% of the financials has a higher weighting, so it would have mathematically, it would have a greater bearing on the generation of the pool of dollars. But again, it's important to have those because they're important metrics for the health of the organization. And again, just having a clear-cut elimination of 70% would be unfair to the greater employee base that really doesn't have a lot of leverage with regards to profits per se, but that still deserve to be paid competitively for the services that they provide.
Okay. And I think you answered this, but I just want to make sure I'm still just want to make sure I totally understand this first kind of pool adjustment process. I think you answered this to Mr. DeFever, but hypothetically, and I know this doesn't happen, it's never this clean cut, but hypothetically, if you met 0% of your operational goals and 100% of your financial goals, you would adjust the overall pool down 30%, right? Because you would have only hit 70% total of your trigger.
Mathematically, yes, that's how that would work.
Okay, and vice versa is also true. So if you hit 100% of your operational goals, 0% of your financial goals, you'd only have 30% total of your kind of goal set. So you'd reduce your overall pool by 70%, right?
Correct.
Okay. So then once you've got whatever that pool turns out to be, that's the total amount of money you have now to divide up amongst your employees in accordance with this second process, it sounds like. Is that accurate so far?
Yep.
And the second process is you take the individual employees, you look at their classification, or you look at their job, their position, and every kind of position has different particular goals, and those are sort of more like individual performance goals that the employees have to reach. Is that accurate?
Yes, their individual performance goals based on established categories such as, productivity, customer service. There's a number of things that we rate our employees on.
Okay. But that whole process only relates to, I guess I kind of skipped a step. I got too excited to talk about I got excited because I felt like I was getting this. So once you have that reduced, I'll use the extreme example again acknowledging that this isn't something that actually happens. But let's say, just to make it easier, again, there's a situation where 100% of the financial goals are met, 0% of the operational goals. So you have a overall pool that's reduced 70%. That's the number you start with. That's the bucket from which you divide up everybody's individual compensation. So as a result of that, everybody's individual compensation, everybody's potential total incentive compensation is reduced, but not necessarily by 30%. Is that right?
Not necessarily, because you may want to compensate certain employees for achievement of goals. If they had a spectacular performance, they may receive a benefit that is higher than that, because we're rewarding for performance.
Yeah, well, but this is the area that I'm a little confused by, because in my mind, you're sort of starting out by establishing a bucket. And that's what that whole 70-30 thing we just walked through. And you can kind of establish that bucket before you ever consider an individual employee's performance. Because the consideration of an individual employee's performance, like for what an individual hypothetical employee X gets for their individual incentive comp, they can still get their own maximum incentive compensation, but that maximum is just adjusted by the size of the bucket. Is that accurate?
Yeah, I mean, when you have a year where you don't have 100% of your bucket everyone gets less.
Right.
It's just that some people may get a little more, and it's not, equally divided amongst all the employees, irrespective of their performance. And that's where you apply judgment,
right,
regarding each individual person's impact on the results that were achieved.
Okay. So my last thing I want to understand is those individual, the individual performance metrics you're talking about a second ago that can vary by position, the lens through which you're evaluating every individual employee. Do those metrics, are those tied in some way to support either financial goals or operational goals? Like, is the structure such that there's a relationship between that 70-30 split and the individual goal levels for each individual employee? Or is the 70-30 just for making that bucket and then you start out this separate process?
It's just for making that bucket. It's not translated into an individual evaluation form that says here's 70% financial. The goals are directly related to the work and the job of the individual. It can be, for example, a meter reader, are you providing good customer service? Are you getting accurate reads? Do you have skips? It's very focused on that individual person. A call center rep, how many calls did you take? How many did you complete? What's your satisfaction rating from customers? Do you have +1 recognition? Are you on time?
Right.
All of that contribute to a metric that's defined in the incentive plan, which is service quality. I can give you examples of any employee that you asked me about that has a direct relation and impact to one of the metrics that are in the incentive plan. But again, the overwhelming majority of the employees do not have, direct responsibilities for, the profitability of the organization. I would say, like I did yesterday, I believe that there's a handful, if not maybe one, employee that has direct responsibility for, the profits of the company. So it would be unfair to eliminate that cost from, our rate case.
Okay, thanks. I understand that. My last question is getting at what you just said at the end there, sort of. And I've heard you testify before, including earlier today, that the purpose of the financial consideration, the purpose of that, the existence of that 70% consideration for establishing the total compensation incentive bucket, as I've been calling it, is to ensure that there's funding for the incentive comp. I've been a little confused by that because it seems like the funding is coming from ratepayers inside this rate case. And so the funding isn't directly, like you're asking for funding dedicated towards this program through rates. So what's the connection between that and the profitability for shareholders?
Well, there is a benefit to shareholders as well. I'm not denying that. I'm just saying that there is a benefit to ratepayers as well, because to the extent that the company operates well, that we are fiscally responsible, and that our employees work towards that goal, we can minimize the number of times we come in to request rate increases. And I think we've shown that, historically. Where we have, metrics to show that we're a very lean organization. We operate efficiently. We provide great customer service with the lean workforce that we do have. So I would argue that customers receive a benefit from ensuring that our employees are paid and incented to achieve, those goals that are outlined in our incentive plans.
I'm still just a little confused about, because my question was more like, if you have this program allowed in this case, and the authority says, sure, go collect revenue from ratepayers to fund your incentive comp program, then what's the connection between the financial performance of the company and the availability of the incentive comp dollars if you're collecting it from ratepayers?
Well, you have that money is a part of the cost of service of the organization, right? If we did not have an incentive plan, and when you look at total comp, when you compare it to the market, when we hire employees, they come on board saying, I'm gonna get my base pay if I achieve my results and support the organization and the achievement of these results. I'm gonna get X dollars. If that's not available to them, it's going to challenge us in trying to hire people. And as you know, the water utility, you need educated, smart people to run the business, a complex business, and we need to attract and retain those employees. Alternatively, what we can do is say, okay, instead of having 10 or 20% of your of your compensation tied to incentive, which again, I believe motivates people to perform, we would be forced to add it into their base pay in order to be competitive with the market, which again, we haven't historically done that because what we have put in place, we believe works based on our corporate results. But we would be forced to do that in some way if in order to hire people into roles within the organization.
Thank you. Okay. That's all the questions I have about that subject. I have a couple of other seemingly random questions. First one's about property tax, pertaining to the read-in actually from this morning. Is the company incurring any costs on those appeals, those property tax appeals in Fairfield and Easton?
Yes,
And are those costs part of this rate case?
yes, they are.
Okay. So, all right, thank you. That's all the questions I have on that. My next questions, at the risk of making everyone groan, going back to the Office 365 conversation. So I noticed that there are 390 subscriptions accounted for this product that's called E3, Microsoft Office 365 E3, that is listed at $381.89 per unit. And that's the majority of the subscriptions. And I did hear the testimony that that's, I heard the reasoning for the 400 for the number of subscriptions total. I understand that. I just wanted to understand. I had two questions about the kind of number of subscriptions. First, I think I heard testimony from someone earlier that said that there are some that the number of subscriptions attributable specifically to Aquarian employees is maybe higher than the employee count because some employees need to be able to use the same subscription on multiple pieces of hardware. Was that part of the testimony today?
We believe that to be true, but we're going to include that in the late file
Okay,
that we're submitting.
thank you. My other question is, so what specific products in the Microsoft 365 family do all these employees need to use? In other words, does every Aquarian employee need access to all of the products inside the Microsoft Office 365 package in order to perform their duties?
We believe that all of the employees require access to the Microsoft Office suite of products. We use Teams to communicate. We have this became increasingly obvious and important during COVID-19 when everyone's working remotely or in the field. All of our field employees have a tough book. That's how they receive their work orders, how their supervisors communicate with them. They sometimes need access to certain folders. So we are a workforce that is connected from a technology perspective in almost every way. And it's really helped us to, again, deliver good customer service, have access to customer information on our SAP system, and things like that.
Okay, thank you. And it looked like there were also those 10 subscriptions for a product called Microsoft Office 365 E5, which was more expensive, $648 approximately. Do you know what the difference is between those two packages and why the company needed those 10 additional higher level subscriptions?
I'll verify that in writing in the late file as well, but my understanding is that that provides a higher level of service and access to certain features that are limited to employees in our IT department and perhaps one in our corporate communications department.
Okay. Is the company familiar with a product called Microsoft 365 Business Premium, which offers Word, Excel, PowerPoint, Teams, Outlook, OneDrive, SharePoint, and Exchange, and is publicly advertised for $22 a month per user?
I'm not familiar with that.
Okay. And is the company familiar with Microsoft 365 Business Basic, which also includes Word, Excel, PowerPoint, Teams, Outlook, Exchange, and OneDrive for $6 per user per month?
I'm not.
Okay. So what's the process? Like, who within Aquarian was responsible for determining the level of subscription to Microsoft 365 that was necessary for the company's needs?
We had a group of employees, but our IT director, along with our technical team, as well as input from the business on what we needed in order to operate, provided that input. I suspect that when you look at the subscriptions that for the cost that you mentioned, it's likely for a simple type of access to files and technology that are not integrated across multi-channels of communication across a small to mid-size organization like Aquarion with no configuration or sharing of resources.
Okay, you suspect that, you just testified, but do you know that?
No, but we will include that in the late file. I'm just trying to respond to, the difference in the costs and knowing how complex the integration of some of these softwares play into the cost and the use of those licenses, how that comes into play.
Okay. And the only other, just going all the way back to one of the first questions I asked, I just wanted to make sure, to ask in the late file if you're going to address, I asked the question about multiple pieces of hardware requiring multiple licenses. Are you going to address whether it's possible for a single user to log on to multiple pieces of hardware using the same subscription?
Yes.
Okay, thank you. My last set of questions pertains to the testimony regarding association dues, OCC 19 and OCC 20. I noticed, just going to focus on one individual association, which is the Bridgeport Chamber of Commerce. The dues for that were listed as $22,750. Is the company aware that the dues for that organization are divided by tiers that provide different benefits? For example, the lowest level of membership might not include use of the organization's mailing list or its Zoom account, and there are increasing degrees of membership that have increasing costs that provide those added benefits. Is the company familiar with those tiers?
I'm not familiar with those tiers.
Okay. Would it surprise you to know that those membership costs range from $360 to $10,000?
Again, I'm not familiar with the tiers.
Okay. But if the highest level tier, labeled presidential tier, was available for $10,000, is it possible that the company's testimony that due payments are not discretionary is inaccurate?
I think the witness testified she's not familiar with the source of information the attorney's referring to.
I understand that's the testimony, Madam Chair. My question was just asking about the accuracy of the prior testimony that those due amounts are not discretionary, that I believe there was testimony earlier that the amount paid in dues are kind of set prices that the company doesn't have control over.
Okay, so I'll have the witness answer to the best of her ability, and pending that answer, we will weigh the credibility of the testimony accordingly. Thank you.
So I'll ask the question again. There was testimony earlier that the prices for those dues are set, established, and that the company doesn't have discretion over the amount that they pay in dues. Just wanted to, I think that the testimony earlier was you, or I don't recall which witness it was, said, I think that they are not discretionary. I just wanted to clarify, are you sure that those dues are set in stone and not discretionary at the company's option?
I believe I was the witness that said that. Based on my understanding of the level of contributions or memberships that we've paid, it was my understanding that that was our allocated cost. But again, I'm not familiar with the different levels as you just described. I can only attest to, the level of support that we've provided to the organization that's been consistent.
Okay. Has the company provided, along with OCC 19 and OCC 20, any documentation from these organizations showing the due costs?
Can you repeat that question?
Has the company provided, along with OCC 19 and OCC 20, any documentation from the associated organizations showing what the actual costs of dues are? Like invoices?
We have not provided it to my knowledge. I don't believe we've been requested to do that.
Okay, I'd like to request a late file showing backup, essentially, documentation that the costs of the dues listed in OCC 19 and OCC 20 from each of those organizations that align with the due payments listed in those exhibits.
Okay, so LAFOGSO 35 is to provide the backup documentation for dues payments corresponding to organizations listed in OCC 19 and 20.
Thank you. And that concludes the OCC's CrossBiz panel. Thank you very much.
Is it possible if we could go back to one of the questions that Mr. Sobolewski had asked that we do have the answer for and remove one of the late files?
Okay.
So earlier we were asked what was authorized in our last rate case for pension expense. And so the authorized figure in the final decision was $5,281,000. And in OCC response 61, we provided the contributions since the last rate case. Did you want me to read them aloud or do you want to? Okay.
Okay, so I think that would have been late file exhibit 34. So since I'm not too far off the numbering, if it's not going to mess anyone up, I will strike 34 and move up the provide the backup documentation one to become the new 34.
Thank you, Madam Chair.
Very good. Okay, so we are going to take a 5-minute break. Well, actually, I apologize. Let me just double check. The Office of Attorney General is not here at this time. Okay, very good. Then we are going to take a 5-minute break, and at that time, we will resume with cross by the EOE, please.
Yeah, that was great. That's like, Sure. Yes.
You're gonna need some giant shirts.
Yeah, figure out when. I know usually I'm in the 1,000, around between 800 and 1,000. I don't know, like, it's like 10 or 12 different kinds of it. Yeah. Yeah, you can bring them to the park, you know, for. I already put my people in my home. No offense. On a Monday, I can come in on a Monday. You're dragging me in here out of this.
Oh, please be seated. Okay, ready, restart here. Attorney Sherry, no cross? Okay, please approach.
Good afternoon. I'm Zach Alexander with the Office of Education Outreach and Enforcement. I just have a few questions for Ms. Texera. And this is an item that's discussed on page 53 of your pre-filed testimony. It's also referenced in response to RRU 165. So in the list of the IT-related projects planned for 2022, item number 7, which is the S4 HANA assessment, I'm trying to get more information on what the deliverable is for this project. It looks like just recommendations or a comprehensive plan. Is that correct?
Yes, it's the plan to implement HANA, which is a highly complex project that would move our SAP system. It would be a huge upgrade and effectively move it to the cloud.
And has that migration begun at this point?
It has not.
Okay. And is it planned to be completed during this year?
The assessment?
Sorry, the migration.
Oh, no,
Okay.
that's not going to happen for a couple of years.
And has the assessment been completed?
Not completely, no.
Okay. So there's currently no asset in production or there's no new software that the company is using related to HANA.
No, it's the planning, it's the assessment. Like I said, it's a very highly complex project. We would have to identify the resources that are needed, the changes across all of our systems. We would have to ensure that we had the right resources in place, again, in order to make that project successful. So it's a pretty intensive, careful, planned project, because SAP is our enterprise system, and we need to make sure that it runs effectively once we begin the project.
Okay, so if you had to give a rough estimate, at what point would you know whether or not the migration will take place? Or have you already committed to the migration?
No, the planning is starting now, will last through next year. And then we'll start a phased approach to the implementation that will likely not begin until 2020, where are we, at mid-2024.
Great, thank you. Then my other question has to do with the company's process when it has the choice or has to make the decision between licensing software or subscriptions or software as a service. Does the company have a process by which it determines whether to purchase a license or whether to purchase subscriptions or software as a service?
It really depends on the intended use of whether it's a software or a license. So that's dependent on whether it's an enterprise software that's used by the entire organization and the integration of that software into other areas of technology, or whether it's utilized by individual departments or just a couple of people. So all of that is factored into the decision.
Okay, so generally, if it's an enterprise solution, what are you leaning more towards?
Well, again, I think some of the requirements are also dependent on the vendor and the solution, so we may not have a choice. So in a system like, we just talked about Office 365, where we implement the software and then we pay a license for the use of that subscription, while I don't have the details, I'm sure it was deemed to be the best approach for us.
Okay, so I guess just sort of stated another way, assuming you had equal choice from a vendor to purchase the software or to subscribe on a monthly or quarterly or annual basis to that software. If it were a piece of software that was only used by a small number of employees, which of the options are you more likely to choose, all other things being equal?
We'd probably choose a subscription. I would, and based on my limited knowledge, I would think that we would choose the subscription.
Okay, that's all I have.
I'm Dave Sherry, another attorney with EOE, and I have some questions about table LAT-2, and this was updated in response to EOE 7. That might actually be a quicker way to find it.
EOE 7, you said?
Yeah, you had embedded an updated table in EOE 7, so that's probably the best place to get it.
Okay.
I guess my first question was with the increase in column or row 8 with the executive positions in particular, there's going to be, is there an overall salary increase commensurate with that?
I believe that in that line 8, there were additional employees related to the acquisition of NESC. So there were employees that were included in there. So assuming that there are higher number of employees, there would be higher salaries.
Would it be possible to get a late file on the amount of salary increase for it might be better to think of this in terms of executive office line on the second, on page 2 of 2, where it changes from 2020 from 3 persons to 2022 to 8 persons. Would it be possible to get a late file on the how much salary increase that equated to?
The increase in the employees in that category were not an overall increase in the organization. They moved from different parts of the organization into there. So we didn't hire more executives.
So below, it says you reclassed 3 employees from customer service and added a new position. So I have to assume there has to be some change in salary there.
What I meant to say wasn't the entire increase wasn't like we didn't hire 5 new people.
Yeah, I understand that. I'm just interested in the let's say the net salary difference between.
I can provide that.
Yeah, thanks. The shift and or addition of those positions.
Okay, I'll identify the difference between the 3 and the 8 and let you know which ones were already in existence, just moved into that group.
Yeah.
And what were new additions.
Yeah, and if it helps, I mean, I assume, for example, if you're going to reclass 1 employee from customer service into the executive line, I imagine that person's pay went up.
Well, no, not exactly. That was me. My head count was just in customer service and it was
Excellent.
just better aligned in that
Well,
department.
if it didn't, then it didn't. But regardless, if you could elaborate on that in a later.
Sure, I will show the movement. And again, in most cases, people we thought it was a better representation of their overall duties rather than, because I have responsibilities for example, IT and other areas. So it was better to put me in executive.
Okay, so that would be Leaf File Exhibit 35 and Attorney Sherry, I just want to make sure the reference was EOE 17.
I'm sorry, EOE 7.
7, thank you.
Thanks. Yeah, just so I think I'm covered there, but that actually you kind of hit on already the next question I was going to ask, which was over the course of 2020 into 2022, if you could elaborate on why it, at least on paper, appears there was a large jump in executive positions.
I will do that.
Either here or in a
Oh,
late
so
file.
as shown in the table A, there were people moved from operations and customer service into the executive group. And then we did have an addition, external person that we hired. And then with the acquisition of New England Service Company, there was another employee that we included in that department per se. So I think it would be more illustrative that I can identify that in the file that we're providing to you.
Thanks. One other thing, last point I wanted to ask about was, so the customer services line item on here seems to hover around 40 people over the past, say, 9 years or so, back to the past rate case. And so I'm curious if you could expand on or elaborate on why, not only from a time perspective, why 40 customer service people seems to be sufficient, but also from a new customer acquisition, for lack of a better term, standpoint, because there's a lot of new customers coming in and a lot of time has passed, but it seems like you have the same amount of customer
Sure.
services.
Sure. So the customer services line item includes our call center, billing, and collections. So it's those three functions in that line item. And we have been able to maintain a relatively flat organization in the customer services group. We've been able to do that by implementing technology. Where customers can more effectively self-serve. So over the course of that time, we've implemented our customer portal, we've upgraded our website, we have introduced on a limited basis a chat feature, we've automated emails so they're routed into our call center. We've used technology, I think, very effectively. Our phone systems are integrated with our SAP system, which allows our reps to handle calls more efficiently. So despite the growth in our customer base, we've been able to maintain our KPIs. We measure those every hour, every day. We track all our complaints, whether it's with Pura or through our SAP system. We have very well-trained reps. We try to work really hard to train them as efficiently and effectively as possible. But we also evaluate what the needs of the customers and the business will be as we acquire systems. And we will do that as we continue to grow. And it's likely that we will need to add staff because you can't continue to maintain that level of service, when you grow really rapidly. And you'll see that from 2021 to 2022, we did go up by 3 positions, and those were employees that were part of the New England Service Company, which we placed 1 employee in the call center, 1 in billing, and 1 in our collections group, and they've been a terrific addition to the team.
Okay, thanks. That's all I have.
Thank you. Okay. Commissioner Karen.
Just one quick question, going back to the incentive program. So after the discussion with Attorney Wheel, what I came to understand is that the pool of incentive money for employees has nothing to do with profitability of the company. If it's all funded by ratepayers.
Well, I think that it does have something to do with the profitability of the company.
I'm not saying it won't help the profitability of the company, but it doesn't matter if the company's profitable or not since they're getting it from ratepayers. Is that correct? Am I understanding that correct? You don't take profits from the company and put it into this incentive pool. Or do you?
I'm sorry, I'm not understanding your question.
So Attorney Wheel made the point that the pool of money for incentive pay is being funded by the ratepayers.
We're proposing that, yes.
Right. So it has nothing to do with the profitability or non-profitability of the company. None of the profits of the company will go into this fund. It'll be funded purely by ratepayers.
That is what we're recommending, that it is funded by the ratepayers.
Right. Okay. Got it. Thanks.
Thank you, Mr. Vice Chairman.
No question, thank you.
Okay. So if I can stick with that line of questioning that the commissioner was just asking about. So in the earlier discussion, I understood you to say that that for purposes of building the company's proposal under consideration in the rate case, you assumed 100% of employee compensation, or 100 that employees would receive 100% of their incentive compensation. Did I hear that correctly?
For budgeting purposes, yes.
For budgeting purposes, okay. What percentage of employees actually achieve 100% of their incentive compensation?
The overwhelming majority of employees have received a payment in the past.
A full payment or 100% of what was eligible?
No, that has been modified over time depending on the overall results of the organization, or it could be for, lack of performance or not achievement of their goals.
Okay.
I believe there was a response in one of the interrogatories that gave the numbers.
That gave the historical numbers. Okay. Okay. But suffice it to say that the number used for budgeting purposes does not reflect actual results over the past couple of years.
Well, when we budget, is that we assume you have to start with an assumption. So we would budget based on 100, and then as we assess the throughout the year, we can see whether we're going to be hitting 100 or 80 or 110.
Okay, very good.
And adjust accordingly.
So when you're building that bucket, 70% of that bucket is a link to the financial performance of the company. Correct. Okay. And separately, I heard you testify that not all employees can affect the profitability of the company. Did I also hear that correctly? Correct. Okay. And I think I'm going to repeat a question that I think Attorney Wheel is getting at, but I just want to make sure I understood the answer. So what is the link between ratepayer funds for that bucket and the argument that customers benefit from employees who have a portion of their compensation as an incentive rather than base? So I can try to ask that a different way, but.
So the way we look at it is employees are incented to perform their duties, which are aligned with product quality, customer service, doing their job efficiently. So we don't have to hire, assuming you have inefficient employees, you'd have to have more employees performing that work.
Mm-hmm.
So we look at, the productivity and their focus on performing their job duties, which would reduce the overall expense of the organization over time, which links to, operating budgets and, and the financial success of the organization.
Okay, so you look at them on the individual basis when you're allocating the payouts from the bucket.
Yes.
Right, but if 70% of the bucket is coming from achievement of goals that those employees are not directly accountable for, what is the link between? I'm missing the connection between ratepayer. So the argument, as I understand it, is ratepayers benefit from employees who have a portion of their compensation linked to performance.
Mm-hmm.
I understand that. And that those employees are actually being allocated incentives, payouts based on their individual performance, but it's coming from a bucket that is based on financial performance of the company primarily, which those individuals are not directly responsible for. So do I have all that correct? And
Yes.
Okay.
Yes, but it generates, again, that pool of dollars. We've just attributed 70 financial, 30 these qualitative measures to generate the pool.
Okay.
And then those dollars are allocated accordingly throughout the organization.
Right. So has there been any thought given to 100% of that bucket coming from anything other than the financial health of the company, since it's being funded by ratepayers?
I'd like to take a different angle on this, if I may, in terms of this notion of cost of service, and what constitutes cost of service. And the angle that I'd like to come from is, it's really a total compensation, right? Our organization has certain business objectives that we need to attain. In order to attain those, we need to hire a workforce, and the best workforce that we can. And we have to avail ourselves to the existing marketplace. So what do we need to do to attract that workforce? Now, we as an organization have a choice in terms of how we like to compensate those employees. We can say out of the box, hey, your compensation is straight salary, 100%, non-incentive, and do that. We have taken a different tack to that. We've drawn in incentives. We laid that out to the organization, to the employee. And we've said to you, if you achieve these objectives, and these objectives is Ms. Texera went into some detail on, having to do with safety, customer service, product quality, service quality. You achieve those objectives, you're advancing the business objectives. Everybody wins. So again, this notion is to, the mechanics of the plan. Why is it 70? Why is it what's 70? What's 30? And all those things. I think the broader question is in order for us as an organization to find the right people that we want to be part of the team, to provide the best service that we can, and to incent them, we need to put in place those incentives to motivate folks. So to me, that is the fundamental question. And this is an essential part of our cost of service. So I think we need to broaden this discussion so that we're looking at the entire total comp, and then it becomes, okay, what is the best structure? Do you want to have a fixed base compensation scheme? Because if that's what the department would like to do, we can do that. It's my view, if we were to do that, I think customer service will suffer. So again, I think the important piece here is what constitutes an appropriate cost of service. And I believe it's this notion of, hey, we need to be looking at what do we need to compensate our employees to attract the right people that we need in the organization.
Thank you. The company did a survey of looking at wages of other companies versus your employees, correct?
We have done, yep.
When was the most recent one completed, please?
I'd have to go back and provide that to you to give you an exact, actually, we do is look at, we use the Hay system to evaluate jobs and compare it to the marketplace. So again.
The Hay system?
Yeah, it's a job evaluation system, and we evaluate those jobs on an annual basis.
Okay, so is that I'm not familiar with the system. Is it like a subscription service? Is it a national protocol?
We use it's a consultant that we use he's a compensation consultant.
Okay.
That evaluates our positions, and then we also align and compare the management team's total comp as well.
And that's conducted on an annual basis, you said?
Not annual, but periodically, because the data doesn't change that much from year to year.
Do you recall whether that survey gets into the granularity of what portion of whatever comps that survey is using? Does it get into the granularity of what that comps breakdown between base and incentive is?
For the senior team, yes, it does.
Not for all job classifications?
Not for all job classifications.
Okay. So for all job classifications, it just provides a bottom line number. And has the company used that bottom line number when you're comparing the base? What number from your employee non-executive employee compensation, when you're comparing your survey results that you get from your consultant, are you comparing base to that, or are you comparing total compensation package to the results of the survey?
We look at base wages, and then we look at what is a typical percentage of your base wages that is competitive to the market.
Thank you. Okay. Does the company currently have an earning sharing mechanism?
Yes.
Thank you. Has there been any consideration given to using the earning sharing mechanism to populate the bucket that would be used for incentive compensation for either rank and file employees or the management team?
The earnings sharing mechanism, as I understand it applies to situations where the company earns in excess of its authorized return. Since its implementation, I think was subsequent to our last rate case around the 2014 timeframe, there was only one point in time which it did apply. And the reason for that was the recent tangible property regulations that kicked in and pushed us into that over-earning situation. And those funds were returned to our customers. So just based upon my knowledge of the earning share mechanism, I'm not sure how it would apply in terms of the example that you're providing.
Are the earnings of the company one of the metrics used for the 70% metric that is being used to fund that bucket? Financial health of the company?
Yes.
Thank you. Who determines the goals of individual employees?
The manager of those employees.
Do they follow a format such as like the SMART format or anything of that nature?
Yes, they should follow the SMART format. And we do have prescribed categories of goals that each manager needs to follow that fall into things like, customer service, productivity, attendance, safety. So those categories need to be populated with the appropriate goals for each individual employee.
And those categories, do you have those approved by job classification? When you say it, I took your response to mean that you have some kind of bank or template or something. And is that done by job classification?
It applies to every employee. That format applies to every employee in the organization, despite their role. It's just that the individual goals are tailored, to that specific person.
Okay. And does anyone have to sign off on those goals besides the immediate supervisor?
Well, the manager approves it, and then the director within that unit should be reviewing and updating them and approving them.
Okay. And it doesn't go any higher than the director level?
Not to the, to the, granular level of every employee. Would just be really hard for us to do that.
Can we refer to RRU 350, please? Okay. So if I'm understanding the response to RRU, I'm not sure I have the right reference here. I apologize. Give me 1 second. I apologize. The reference is RRU 353. So in the response, it references Eversource Energy's charge to Aquarion, and then how that factors down to Aquarion Water Company of Connecticut, and says that one component of the management fees is what this amount is responsible for. My question is, which officers from Eversource Energy are comprised in that $435,162 that's allocated to Aquarion?
That's actually subject of one of our late files. That we're going to be providing the composition of that.
Okay, I thought so, but not couldn't find it in my late file list. Okay, so we're getting that. Very good, thank you. Okay, so yesterday we talked about the management fee, and specifically the management fee of the parent company prior to Eversource. And I seem to recall that Eversource's management fee is roughly $75,000 more than your previous parent, thereabouts. When we refer to the management fee, is the charge for the Eversource officers part of that management fee, or is it incremental to the management fee?
The 474,000 in terms of what we're calling the management fee is one component of the charges that we receive from Eversource. So we had another response where more detail was provided behind those charges. I think it was EOE, it's either 45 or 46. EOE 45. So what we tried to present in EOE 45 was all the types of charges that we receive from our parent company. So we have the officer billing, which which is akin to the management fee that we received under Macquarie's ownership prior to Eversource. We have other fees that are reflected here that previously were services that we either had in-house or that we sought external resources for. So for example, the next line, which shows treasury and tax services. Prior to the Eversource acquisition, we had our own treasurer who was an Aquarion employee, who after the acquisition is now an Eversource employee, and he provides services to the Aquarion companies. And to the extent that we use his services, we're billed for the hours that are incurred. So we're only paying for what we use for that position. Again, the next item, there's some legal, environmental, and regulatory costs. Again, those would be Eversource employees who are supporting Aquarion, and we only pay for the services that we receive. To the extent that they have hours charged, they'll appear here.
Okay, that's helpful. I think what I'm trying to understand is if there is a specific difference between the management fee and the officer fee, or if we're using them as synonyms.
We are using them as synonyms.
Okay, thank you. So I'm interested in understanding more about the interaction between the executives of the Eversource parent and the officers of Aquarion. So my first question is, are there regularly scheduled calls between any or all of the Aquarion officers and any of the Eversource officers for which you are being billed?
Yes, there are. I'm speaking on a bi-weekly basis, at least with the COO of Eversource, Werner Schweiger. I speak regularly to the CFO, John Marrera, on a multitude of issues. So yes.
Thank you. Is there a current delegation of authority document on file with PURA between Eversource Energy and Aquarion? And by that, I'm referencing, something that looks like the types of decisions that you can make up to a certain amount without consulting the parent company.
I'm not aware of any specific document between Eversource and Aquarion. I am aware that, within the Aquarion organization, we certainly have authorization delegations, which go up to the Aquarion board of directors, which would include Werner, as well as actually, I would include Greg Butler and myself and Lucy Texera. So we certainly have that exists within the Aquarian organization, and we certainly can provide that. To the extent that there's been anything provided between the Eversource organization and Aquarian, I'm not aware of anything, and that would be something we need to look into to see if something's been filed.
Okay, I appreciate that. I think I leave that there. Are you included in any strategic retreats, strategic planning retreats that Eversource Energy holds for multi-jurisdictions and multi-sectors?
Well, certainly included in offsite meetings. We had one about 2 weeks ago in New Hampshire across all of the businesses. And much of the Aquarian management team was included in that offsite. So roughly, I think about 10 of us attended, were able to attend. So the answer is yes.
Okay, thank you. Can you speak to the frequency of those strategic planning retreats that you participate in with Eversource corporate?
They are biannual. COVID had an impact on that. So the one that was conducted a couple of weeks ago was the first one that we had in about 1.5 years or 2 years.
Okay. Do you discuss acquisitions of small water companies with Eversource corporate? Or understanding that you've alluded to 1 or 2 of their officers being on your board, do you discuss acquisitions with Eversource corporate in advance of them occurring? Like, are you required to seek or receive approval before you pursue an acquisition?
Yes, and any and all acquisitions we will consult with Eversource.
Are any portion of, so we were talking about the funding of that bucket earlier with respect to incentives, the 70-30 split, is any portion of that 30% or alternatively the 70% tied to a certain number or size of acquisitions in any given year?
I don't believe so, no.
Thank you. Okay, so referencing RRU 353, and then there's a later RRU.
I'm sorry, excuse me, Madam Chair. I stand corrected. We do have a growth metric that is built into our short-term incentive plan. So that would be.
You do have a growth metric.
Yes, yes.
Is that for all employees or for executives?
That applies to all employees.
Thank you. And can you elaborate on that? Is it growth in terms of the percentage of sales or number of customers or both?
There'll be number of customers.
Okay. And that is the metric that feeds into the creation of the bucket, the 70-30, or is this a growth metric against which customers receive an evaluation, like their individual evaluations?
It's part of the financial metric, which is in that 70% bucket. So it's one of the components of that.
Okay, thank you. Okay, so RRU 353 and RRU 440 both address questions around compensation. I was a little confused in the response between the two of them. I want to make sure that the distinction the company is trying to draw is that no incentive compensation for Eversource officers is being recovered from Aquarian ratepayers, not that, because I think I understood RRU 353 to be saying that you are recovering or seeking to recover from Aquarian ratepayers Eversource officer salary, but it's base or payroll. And so the distinction that you're trying to draw in the response in 440 is that you're not seeking any incentive compensation for Eversource officers. Is that?
That's an accurate statement.
That's accurate. Okay. Okay. So with that being said, I recognize that RRU 440 was perhaps not worded the best, but I didn't find the answer responsive, at least to what I was seeking, and I think that was my fault. But let me just try to explain what I was hoping for there. You provided an exercise in response to RRU 439, where you walk through the incentive compensation and the bill impact for acquiring officers. I was seeking that same analysis in response to 440, but instead what was provided was, well, you're not seeking anything, but you're not seeking any Eversource incentive. Do you understand that?
I understand. So in late file 18, that's where we're going to be providing the listing of officers that are included in that 474,000. And I'm just looking at my notes here. We're going to have the amount by officer and the percentage of their salary. We could, in conjunction with that response, add in a table similar to 439. So essentially, we would just be taking the expense amount
exactly
and computing the rate impact.
Thank you. I'm specifically looking for the rate impact in the same way that you've done it above. But what you've done in 439, just so I'm clear about what I'm looking at, is you've done exercise 439 only on the incentive compensation for these officers, correct? It doesn't include their base.
Correct.
Okay. Can you repeat the exercise in 439 for the base compensation of like the format? Everything was exactly what I was looking for. I was just hoping to have
certainly
the total. Thank you. So let me I'll turn to your attorney Pace or Attorney Vaughn. Would you prefer I make that a separate late file, or do you want me to add that on to late file 18?
We're fine with adding that to late file 18.
Okay. Thank you. Thank you. Okay. Okay, I'm almost done here. I'm not sure whom to address this question to, but is the company familiar with Public Act 20-5, Section 4? It's colloquially known as the Take Back Our Grid Act.
I'm aware of it. I've heard it in the news, but I'm not versed on it.
Okay, so specifically, and I could have been more specific in my question. I'm specifically wondering if any company representative is aware of the authority's authority to tie any portion of the compensation package for executives or officers or any employee, so long as we're talking about the portion of the compensation that's recoverable in rates, to the achievement of performance targets. Is anyone aware of that? No. Okay.
And Chair, we're happy to take a late file if there's a specific question as it relates to Section 4.
I think I'll go ahead. I appreciate that. I'll go ahead and ask my question, but I don't think you're going to need a late file exhibit to respond to it. My question in asking whether the company was familiar with it was whether the company had revisited its any portion of its compensation structure for either the executives, officers, or rank and file employees following the passage of this section, specifically because of this section. And I take it
that we have not.
Okay, thank you. So I don't need a late file on that. Thank you. Okay. So earlier I asked the question about who determines individual employees' goals. I imagine that executives or officers receive goals of their own is.
We do, yes.
We do. And who's responsible for setting those, please?
Each individual's or each employee's manager is responsible for identifying those goals. And I think an important aspect, what we haven't really covered is, it comes full circle. The performance appraisal process is an important part of that. And ensuring that goals are attained and again, it ties into incentives and so on.
Thank you. So when you get to the top of the company, so with respect to you, Mr. Morrissey, who sets your goals?
Mine would be, my boss is Werner Schweiger.
Thank you. And for executives or officers, who determines the percentage of salary that is base versus incentive? Because I thought the 70, well, let me stop there. Who determines the percentage breakdown between the base versus incentive of executives and officers?
It's based on the analysis that we do with the third party to determine what is best practice, what is fair with regards to payment of base wages, short-term and long-term, to get a total comp package that is competitive with the market.
Thank you. And is that done at the Aquarion level, well, I guess it wouldn't be done at affiliate. Yeah, is it done at the Aquarion level, that survey?
It's done at the Aquarion level. We do utilize Eversource, their compensation group, to assist us with that analysis.
Okay, thank you. And when you say you utilize them, are they providing benchmarking to other portions of their business, whether or not they're water?
It's more water utility based. It's not apples to apples comparison when you're looking at water, gas, and electric.
Okay. And what's the frequency of that analysis? Is it the same frequency we were talking about?
We're in the process of doing that right now in preparation for year end. So we do that every couple of years.
Okay. Is that the same analysis that we talked about just a few minutes ago for like more of the rank and file employees, or is this a different analysis?
This is a different analysis.
Okay. Is it done at the same time or on different?
It's done, we're doing it right now for the executives, and we look at, we do it in the first quarter of the year for all other employees.
Okay. And not annually.
Not annually for the executives.
Okay. Okay. The goals that are set for the executives, please, are they so the achievement of the goals feeds into the incentive compensation? Does it feed into anything else? I can't think of anything, but I just want to make sure the link between your achievement of your goals is just tied directly to the incentive compensation. Anything else?
Well, it's tied to, succession planning and ensuring that our employees are performing at an optimal level. So yes, it's directly linked to, your compensation, but it's also an opportunity to gauge whether employees are, delivering on the objectives that their manager needs them to perform at.
Okay.
Yeah, and I think at the management level, I think the key piece is the tie-in really comes at the company-wide level, right? So to the extent that we've got major initiatives that we're trying to accomplish during the year, is using Ms. Texera as an example in terms of certain customer service deliverables. That'll be part of that's going to be a significant goal, and it's really under an initiative because it's multifaceted, and to the extent that there may be a large IT project or something to be delivered on that front. Again, that would be again, it's tied into an overall organizational goal, but it flows through to Ms. Texera, and it continues downward to the director of IT or the customer services organization to be sure that their metrics are being hit. So again, things are linked in terms of the establishment of goals, the follow through, and the appraisal and incentive and reward system.
Thank you. And there, just to confirm from a few minutes ago, there is a growth parameter in your executive goals that links to incentives, correct?
That is correct, yeah.
Okay, thank you.
So, and again, that goal is an example for 2022. Our goal coming in because we recently closed on the Torrington Water Company acquisition is an example. So our goal for this year, I don't know precisely what our goal was, but it was probably adding somewhere in the order of, 10,000 customers, which was something that we had on our radar and we were able to follow through and deliver on in 2022. Similarly, in 2021, we had a similar goal, and in that case, we brought on the New England Service Company and the 3 subsidiaries, operating subsidiaries under New England.
Very good. Thank you. Okay, I'm gonna put a pin in that. Let's stop here. So I'll see Attorney Pace. Do you need a brief recess to consider redirect?
Yes, please. Thank you.
Okay,
I'm sorry.
5 minutes.
5 minutes. Thank you, Chairman.
Okay, we'll recess for. We'll recess for 5 minutes. Thank you.
If you're here when I bring them in.
I gotta make my shopping list anyway, so find all that stuff.
White chocolate chip instead. Wow. So like this is sugar cutout. What shape?
I don't know, I got about 7 or 8.
Do you use all the different ones? Or just pick one or two?
I start finding the ones that are easier to do.
Oh, got it. Oatmeal raisin, oatmeal scotch, gingerbread, love gingerbread. You just chocolate. So what do? You want
Chocolate, chocolate cookie.
Yeah, and then you
Put them in the last like 5 years.
And it melts. Yeah.
I just really like.
I mean, it's the recipe.
And I use Crisco.
You do? Yeah.
Yeah. The last
I'm
time
I'm
I
at, I only own.
gingerbread are kind of.
Like full feet. My third.
It's lost.
Have to
popularity.
recycle starting tomorrow.
It gives me inspiration. Well, you can do a recipe swap. That's what I was thinking. In addition to the cookie swap. Right. Oh, there we go.
Well, my cookies won't be made by then. I used to plan, I used to participate in planning the holiday party when it was a batch. When it was a batch.
No, maybe the cookies for us?
Oh, thanks.
Make fermentation.
When it was the batch.
They're the cookies with the filling in them that are like triangle. I found a no-fail recipe, so like even though I think I failed, they still tried. What's the filling? I prefer apple pie, but I could do like chocolate, butter, any sort of jelly. We'll do pie, which
And a lot of Polish stuff up to a.
Happy gross. I think I might not go to that.
Open you go.
My flight's at 1 tomorrow.
It'll be done in a half an hour.
I'd say. Wait, but no, the hearing starts.
I did, I found a strong recipe, and those are the three. Yeah.
Well, they only have
The
15
first time
minutes
I made
scheduled.
it, I think we called for free fries. I don't know where time was. I just used so normal. I think they were so good.
I'll give a short answer.
Their freezer is so good, but I did get so they don't.
Yes, no.
I agree. Whatever you say.
Well, that's what I used to bring in, I used to make sure to bring in. The taste testers, like cutting out how they are, I don't need to.
Oh, you don't make any.
Yeah, so I need to.
I need my. I'm not very good at it.
Sometimes, yeah, I prefer to taste, but I'm not. Beard oil.
Yeah.
Joel, yeah, because my.
Yes.
Well,
That took a while.
my 2 sons are years and my daughter's fiance. And she put all your
Wow.
Oh, my God.
Yeah. I cook, I mean, my family's still alive.
That's what I subsistence cooking. Yeah, no one's died, everyone's still, moving along.
I heard better.
Yes, that's where I got my one. They have ever died. Yeah. I
You
went
guys
in
don't
there,
smoke
they gave a
cooking, you
little,
typically.
like a bar and
We
out
do
in the
split
back.
it, but when I.
Essentially where they tell one sample was like, I'm not sure, I'm not even. Like, yeah. I took pictures of.
Oh,
So he's, because I'm here, to shoot around his face.
We don't have.
I want to take up this week, getting back later.
It's hard, like,
I feel like.
we're here 5:30, by the time you go home. Who wants to vote?
Got leftover lasagna. Set up.
And it tastes
It's better.
We had the parties last day. At a restaurant or something.
Oh, yeah.
Oh, yeah. Yes. Mary Lyon.
Like under the holidays, I do that, but what else are not?
Oh, yeah.
I like the beginning of it.
Yeah. That's a good one.
Yeah. Commissioners out
All right, Attorney Pace, don't let me forget to ask you about the read-in, but we can, I don't know if you want to, if you have that, or if you want to do that after cross the OCC question.
Okay, and I believe that was a read-in G.
Correct.
And it was the request on OCC 21. Is the $30,000 for advanced CT fixed, or is that variable? And I think we're gonna need some additional time to research that. And so if we can provide an update either later in the day or first thing tomorrow morning, would that be acceptable to the chairman?
Yes.
Thank you, Chairman. And Chairman, we covered a lot on that last panel, but I'm going to limit my redirect to just two very targeted and specific issues to be very brief.
Okay.
Mr. Morrissey, do you recall the questions you received from the panel that asked about why the company has among its metrics, a metric that focuses on whether there's growth in the customer base for Aquarian? Do you recall that line of inquiry?
Yes, I do.
Can you please identify how customers benefit when the size of Aquarian expands and we take on additional water companies?
Certainly. Well, first of all, I think it's important to understand that as a water utility, there's tremendous economies of scale that are available as we do expand. So I think it's important to note that as we execute and are successful in growing, in adding these new customers, that in the long run, all customers will benefit because it will lower the costs to all in the absence of that growth. So that is the rationale as to why we include this in our incentive compensation arrangement.
Thank you, Mr. Morrissey. My final question on redirect is in sticking with the issue of questions we received about how do customers benefit from various items discussed on today's panel. Mr. Ulrich, you received a number of questions about data response QOCC 19 that identified the company's membership dues for organizations like National Association of Water Companies, Water Research Foundation, and American Water Works Association. Can you identify how our customers benefit from the company's participation and membership in those organizations?
Yeah, I appreciate the opportunity. We had hit on this, but we moved on to OCC 20 pretty quickly. But I did want to highlight the importance of being part of these organizations. They create the documents that we use as our industry standards. So it's important to be a part of those, a part of the associations, part of attending the conferences. And they're also in on the conversations that are very important today around PFAS, lead and copper, and also in the conversations they're developing the regulations that are going to have an impact on what gets implemented and what are the requirements we have to meet going forward.
Thank you very much. I have no further redirect for this panel.
Very good, thank you. So we can move on to our next panel. We have on the same topic, but the witness is the Office of Consumer Counsel. So if we can do a little reshuffling here and recall witness DeFever, please. Okay, I think we can move into this panel. So Attorney Pace, any cross for witness DeFever?
I do, Chairman. Thank you.
Okay.
Good afternoon, Mr. DeFever.
Good afternoon.
I'm going to have you first refer to your pre-filed testimony dated October 26th. And the first page I'd like you to refer to is page 10 on payroll, and let me know when you're there.
There.
Okay, again, if any questions I ask are not clear, please ask me to clarify and take whatever time you need before responding to any questions. Do you see that on page 10, line 11 of your testimony, is it correct that you recommend that the company not receive funding for 22 employee positions?
That's correct.
And was your analysis in the October testimony based on a specific point in time?
Yes.
And would you agree that on that same page 10 at line 8, you state that your testimony and your recommendation was based on your review of information as of September of 2022?
Yes.
And do you recall that yesterday, during my cross-examination of you, I asked you, did you review the rebuttal testimony sponsored by Ms. Texera, Ms. Zabo, and Mr. Unger that was dated November 9th of 2022?
Yes,
Okay. Did you know that on page 9, line 5 of that rebuttal testimony that was filed on November 9th, Ms. Texera said, as of that moment in time, the company had reduced its open positions from 22 to 13.
yes,
And were you in the hearing room yesterday when Ms. Texera testified that based on additional efforts to fill open positions, as of yesterday's hearing, the company had reduced that number to now 12 open positions?
yes, I was there.
Do you agree that in light of those updates to the record, you would adjust your recommendation to authorize funding, not to disallow funding for the 22 positions, but your recommendation would be updated to not provide funding for 12 positions? Do you agree with that adjustment?
I don't. However, I am open to updating at the end of the hearing period, but I would not go any lower than the 8.6 vacancies that they've averaged. I feel since they've had vacancies for every month of the last 69 months, it's pretty safe to assume they will continue to have vacancies. There's no reason to think that they won't.
Okay, so if we could now turn to, I believe it's page 11 of your pre-file testimony. And let me know when you're there.
Okay.
And do you see at the very top of that page, you have a chart that's labeled vacancies 2017 to 2021, is that correct?
Correct.
And is it your calculation that over that 5-year period, on average, despite the company's best efforts to fill positions, due to attrition and other factors, there's an average vacancy rate of 8.6 full-time equivalents?
Right.
You also see that at least in 2 locations in your pre-file testimony, you reference a Connecticut Water Company decision issued in docket 2012-30 that was dated July 28th of 2021.
Can you give me one of the locations?
Sure. One of the locations appears at page 5, lines 7 through 8.
Okay.
And then you also refer to that same decision on page 20 at line 5, is that correct?
That's correct.
Is it fair to say that the purpose for your citation to the Connecticut Water Company decision was to rely upon that as precedent, or at least as an influential basis to support a recommendation in your pre-file testimony?
Yes.
Did you happen to read the decision in that docket, or did you read it just as to specific issues?
Just specific issues.
Okay. Chairman, what I'd like to do is have Mr. Vaughn put up on the screen a copy of that July 28th, 2021 Connecticut Water Company decision that is referenced in Mr. DeFever's pre-file testimony. And Mr. Vaughn, could you please show page 7 of that decision? And what I've done here is the highlight does not appear in the original. I've simply had that added to facilitate the cross-examination. Let me give you a moment to read that.
Okay. Yeah, I read it. And I am now that I've read it, I have read it recently.
And would you agree that at page 7 of that decision from last year, the authority also applied the concept of a vacancy rate?
Yes.
Okay. And again, to the best of your knowledge, is the intent for using a vacancy rate to recognize that no matter how hard a company tries, there will be situations where they will have at some points during the year open positions?
I can't say that's the intent, but yeah, I can't say that.
Okay, and on page 7, do you agree after, reading it, that for Connecticut Water Company, the particular vacancy rate based on the evidence in that record was 6 full-time positions?
Correct.
And again, circling back to your own testimony, your calculation based on your review of the record evidence would be that for Aquarion Water Company of Connecticut, that would be an average vacancy rate of 8.6 full-time positions.
That's correct.
And if the authority decides to follow the 2021 Connecticut Water Company precedent and decides to utilize a vacancy rate, do you have any objection to the authority using your calculation of 8.6 full-time equivalents in your pre-file testimony?
If the company still has 12 vacancies, I would still recommend that they use the 12 vacancies rather than the 8.6. The 12 vacancies would be the most known and measurable at that time.
Let's circle back. So is it accurate to say that when you prepared your testimony using September numbers, the company had 22 open positions at that time? Is that a true statement?
Correct.
And when Ms. Texera updated the record on November 28th, the company had now updated that to only 12 open positions.
Right.
Do you recall her testimony yesterday where she said the company continues to work very actively to fill those open positions?
I don't remember that, but that makes sense.
But
again, based on the record, there's no reason to think that they will. In fact, my testimony doesn't cover this, but in 2022, they've averaged 17.6 vacancies every month.
And did you know, would you be surprised to know that among those 12 positions, they include positions in customer experience, utility operations, and water quality field services?
I would not be surprised.
So based on the track record that you've seen that's in the record, a movement from 22 open positions to 12 open positions, coupled with the statement by the witness yesterday, they continue to work actively to fill those positions, you would continue to advocate for a disallowance of 12 positions?
Whatever the amount was, not positively, but I'd be more open to the vacancies at the time because they're most known and measurable. And the idea that, the witness says that they're, going to try to hire these people. Well, I imagine for the last 69 months, they were also trying to hire the amount of people they had. They simply weren't able to. I mean, I assume.
And you would, just to circle back, you would agree that in the Connecticut Water Company precedent, the conclusion was it was just and reasonable to allow the requested payroll expense subject to disallowance for the average vacancy rate. Isn't that correct?
That was the decision, but I don't know the rest of the particulars. I don't know how many vacancies they had at that time.
And your own calculation in your own pre-file testimony was that over a 5-year period, the average vacancy rate for Aquarian Water Company of Connecticut is 8.6 positions, correct?
That's correct.
Okay, thank you. I'm going to move on to the topic that received quite a bit of discussion earlier today, which is incentive compensation. I only have a few questions.
Okay, 1 second, please.
Sure. And where that topic first appears in your pre-file testimony is, I believe it first appears on page 14. Just let me know when you're there. Take your time.
Okay. I think I have it on page 12.
Okay. If you could turn to page 14.
Okay.
And let me know when you're at lines 18 through 19.
Where?
Just to confirm for the record, it's your recommendation where you say there, I recommend a disallowance of 70% of employee and officer incentive compensation. Is that correct?
That's correct.
And again, just to be clear, that's not applying to officers. You're applying that to day-to-day non-executive employees. Is that correct?
I'm applying it to the entire incentive comp.
Okay. And I know you were in the hearing room yesterday and in the hearing room today where you heard Ms. Texera testify that the company is looking to recover 100% of its incentive compensation. Did you hear that testimony earlier today?
Yes.
So if you disagree with Ms. Texera's request, would you agree that at a minimum, the authority should follow its precedent in prior rate cases involving regulated water companies?
Oh, no. No, if they were only always going to follow precedent, there'd be no reason to have these hearings.
Okay. And what I'd like to do is, since you do reference two water company rate case decisions in your pre-file testimony, I'd like to at least have a discussion about what that precedent says, and you can provide your reaction to that. So if I can have Mr. Vaughn, please bring up the Connecticut Water Company rate case decision we just talked about. I'm going to ask him to please go to page 10 of that decision. And again, the highlights do not appear in the original. I've simply added that to facilitate today's cross-examination. Do you agree that page 10, the highlighted sentence says the authority's precedent, as noted above, is to split the expense of incentive compensation and other bonuses 50-50 between ratepayers and shareholders? You agree that's an accurate statement?
That's what it says.
Okay. And also in your pre-file testimony, you refer to Aquarion's last rate case decision that was issued in 2013 in docket 130220. When asked Mr. Vaughn to please bring up that decision. And Mr. Vaughn, can you please turn to page 50? And once again, once he arrives at page 50, the highlighting does not appear in the original. I've added that to facilitate today's cross-examination. And Mr. Vaughn, can you just toggle down a little bit to the top? The sentence carries over. And Mr. DeFever, would you agree that the language says the employee bonus expense should be recognized as part of the company's overall compensation plan, which targets market-based compensation of employees? The authority concludes that the employee bonus expense be a shared expense between ratepayers and shareholders. Therefore, the authority will allow 50% of the requested Connecticut allocation of employee bonus expense. And it goes on to provide a citation. Would you agree that's an accurate reading of what appears on those pages?
I agree that's what it says. However, I'm not aware of the particulars of that plan. So it really could be an apples to oranges situation here.
So would you agree that based on...
In fact, they call it a bonus plan instead of incentive compensation plan. And I think the company would rile at the idea that calling theirs a bonus plan.
So putting aside the particular terminology that was used by the authority's own words, state that they're calling it bonus, and they also use the word market-based compensation. So based on that conclusion, do you agree that currently right now, the only amount the company is recovering in rates for incentive compensation would be 50% of the amount that was shown in rate year one of their 2013 rate case? And if you don't know, you could just say you don't know.
I don't know.
Okay. And so if the authority were to elect to follow precedents in the company's last rate case and the 2021 Connecticut Water Company rate case, would you agree that if they elect to follow precedent, the company would be granted 50% of the incentive compensation they've requested?
I think you're just asking me if those two cases was a 50-50 split, and I would agree with that.
Okay, thank you. That concludes my cross-examination for Mr. DeFever. Thank you very much, Mr. DeFever.
Thank you. Attorney Marshall. No cross. Thank you. Is the Attorney General here? No. Attorney Sherry or Attorney Alexander? Thank you. And Pura staff, Ms. Skouras, please.
Good afternoon, Mr. DeFever.
Good
I'm
afternoon.
going to try and be as brief as possible. We
Oh,
had
thank you.
one question, and it's a follow-up to a cross-examination earlier today. Rita Skouras with the Pura staff. Earlier today, In response to OCC 189, it was determined that the company's actuary downwardly revised the pension expense to 1.225 approximately million. Do you recall that?
No.
You don't? That's your own response to your own interrogatory, OCC 189.
I thought you were asking if I remember them discussing it earlier.
Yes, we had cross about it with the company. Were you present?
I'm just saying I don't specifically remember that.
Okay,
but-
well, here is the response here.
Okay.
Okay. Has the company, I'm sorry, did OCC review the proposed change here in the response? Do you have had an opportunity to do that prior to today?
No, I haven't reviewed it.
Okay, in your pre-filed testimony, is it correct that you recommended disallowance of SERP, approximately 13,000 for the defined benefit and 97,000 for the defined contribution?
That's correct.
Okay, but for the record, the OCC had no position on this rather large reduction?
Right. I'm not aware of it.
Okay. I know there's a late file on it, but would it be possible to maybe get an update from OCC on their position on this reduction to the pension expense? Would you be willing to take a late file?
Yeah, I'll take a look at it.
Okay.
The alternative, Madam Chair, since it sounds like Ms. Skouras is asking for a position, we could just address it in our brief. I'm not sure that our position needs to be evidence submitted in the form of a late file, although we wouldn't object to a late file.
Ms. Curtis, are you seeking solely their position, or are you seeking a factual matter?
I suppose it's a position because it is factual what the reduction is.
Okay, let's address that in the brief, please.
Thank you. We'll be sure to address that. We'll look at that update and address it in the brief. Thank you.
That's all I have, Commissioners.
Very good. Thank you, Commissioner Karen. Okay, I also didn't have questions at this time. Attorney Wheel, do you need a moment to consider redirect?
No, but I have one question on redirect
Okay.
that Mr. DeFever doesn't even know I'm going to ask.
That's right.
This is just for the record because I think you didn't get a chance to fully articulate it. It sounds like your testimony is that with regard to the current actual vacancies of the company, that your recommendation would be for the authority to disallow the total number of open vacancies as of the close of evidence in this hearing?
Unless it was less than the vacancy rate, the average vacancy in 5 years, I would at a minimum take out the 8.6.
Thank you. Thanks for that qualification. And I did hear you testify that, so thank you. But as long as it's 8.6 or above, it would be the actual as of the time of the close of evidence, correct?
Correct.
Thank you. No further questions.
Okay. Very good. Thank you, Mr. DeFever. I think we are concluded with this panel. So we are going to adjourn for the day. We will reconvene tomorrow. Just as a reminder, it's not until 1 p.m. So we'll reconvene tomorrow at 1 p.m. and we will pick up with the operational efficiencies and cost savings non-revenue water conservation panel with authority staff up first for cross-examination. Are there any closing matters before we adjourn? All right, very good. We will see everyone tomorrow. Thank you.
Yeah.
Robert, I'm not coming in.